101 Dumbest Financial Decisions Ever Made. 1. In 1634, Dutch tulip traders created the first documented financial bubble in history. Ordinary citizens mortgaged their homes to buy single tulip bulbs for the price of mansions, convinced the flowers would make them rich. Why? Because everyone else was doing it. The market reached its absurd peak when a single Semper Augustus bulb sold for enough to buy a luxurious Amsterdam canal house. Then, in February 1637, buyers simply stopped showing up to auctions. Overnight, tulip prices collapsed by over 99%, bankrupting thousands across the Netherlands. No government bailout arrived. No regulations followed. Just economic devastation and a powerful lesson that apparently needed to be learned again and again through history. When an investment's only value comes from finding someone willing to pay more for it later, you're not investing. You're gambling with particularly terrible odds. 2. The South Sea Bubble of 1720 stands as perhaps history's most spectacular demonstration that fancy titles don't equal financial wisdom. The South Sea Company, granted a monopoly on British trade with South America, saw its shares skyrocket from $100 to over $1,000 in just months. Everyone from servants to royalty threw their life savings at it. The genius physicist Isaac Newton initially invested $3,500, sold at a tidy profit of $2,500, then, watching others get richer, jumped back in with $20,000, equivalent to millions today. When the bubble burst, Newton lost nearly his entire fortune. The mathematical mind that calculated the laws of motion and universal gravitation couldn't calculate basic market hysteria. Newton later remarked, "I can calculate the motion of heavenly bodies, but not the madness of people." Parliament's subsequent Bubble Act attempted to prevent similar schemes for a century afterward, but human nature proved far more persistent than any regulation. 3. The 1719 Mississippi Company bubble began with John Law, a Scottish mathematician and gambler who convinced France's regent that he could solve the nation's crushing debt. His plan? Print massive amounts of paper money backed by promised riches from French Louisiana Territory. Law's Mississippi Company soon controlled France's national bank, tax collection, and foreign trade monopolies. Shares rose 900% in a year, creating such mania that the wealthy fought for investment access. When questions arose about the actual value of Louisiana's resources, investors rushed to convert shares to gold. The company couldn't pay, the currency collapsed, and France's economy was devastated. Law fled the country he'd recently dominated, dying broke in Venice 9 years later. The disaster was so traumatic that France wouldn't establish another national bank for 80 years, and French citizens developed a lasting cultural aversion to paper money and financial speculation that persisted for generations. 4. From 1991 to 2008, Bernie Madoff orchestrated the largest private Ponzi scheme in world history, a $65 billion fraud that collapsed during the financial crisis. Madoff, a former NASDAQ chairman with impeccable Wall Street credentials, promised consistent 10 to 12% returns regardless of market conditions. The impossible consistency should have been a red flag, but his exclusivity and reputation kept investors begging to get in. When markets crashed in 2008, investors tried to withdraw $7 billion, exposing that Madoff had never actually invested their money. He simply used new investor funds to pay returns to earlier investors. The fallout was devastating. Charities closed, retirement savings vanished, and several victims committed suicide. Madoff received 150 years in prison where he died in 2021. The SEC, which had investigated Madoff multiple times but found nothing, implemented sweeping reforms afterward. The case demonstrated how devastating the combination of reputation, exclusivity, and greed can be. Even sophisticated investors suspended disbelief because they wanted so badly to be part of Madoff's special club. 5. Enron's 2001 collapse represents the moment corporate America's creative accounting practices finally hit their logical conclusion. The energy giant reported profits of $979 million in 2000, but secretly hid massive losses through thousands of shell companies and accounting tricks that would make a carnival magician blush. Executives used mark-to-market accounting, to book profits from deals that wouldn't earn money for decades, if ever. When whistleblowers and journalists began questioning the numbers, the house of cards collapsed, revealing $38 billion in hidden debt. Enron's stock plummeted from $90 to pennies, vaporizing $74 billion in shareholder value and $2 billion in employee pension funds. Meanwhile, executives had sold their own shares near peak prices. The fallout led directly to the Sarbanes-Oxley Act of 2002, which created strict new reporting requirements for public companies. The company's accounting firm, Arthur Andersen, was convicted of obstruction of justice for shredding documents, ending the 89-year-old firm's existence and reducing the Big Five accounting firms to the Big Four. 6. Long-term capital management's 1998 collapse proved that being brilliant doesn't protect you from being catastrophically wrong. The hedge fund boasted 2 Nobel Prize-winning economists and Wall Street's elite traders. Their complex mathematical models showed they could make virtually risk-free profits through bond arbitrage. So confident were they in these models that they borrowed over $125 billion against just $4.7 billion in assets, a leverage ratio that would make even the most aggressive gamblers nervous. Then Russia defaulted on its debt, triggering market movements their models had calculated as mathematically impossible. LTCM lost $4.6 billion in 4 months, threatening to collapse the entire financial system through its connections with major banks. The Federal Reserve orchestrated a $3.6 billion bailout from Wall Street firms to prevent global financial contagion. The spectacular failure of LTCM demonstrated that even geniuses can't model human behavior and market panic, a lesson that would be forgotten just a decade later during the 2008 financial crisis. 7. Black Monday on October 19, 1987, remains the most devastating single-day crash in stock market history. The Dow Jones plummeted 22.6% in just hours, twice the drop of the worst day of the 1929 crash. What triggered it? A perfect storm of international tensions, rising interest rates, and most importantly, computer trading programs designed to automatically sell stocks when markets declined. These programs created a feedback loop. As prices fell, computers triggered more selling, causing prices to fall further, triggering even more selling. The crash revealed how vulnerable markets had become to technological amplification of panic. The immediate aftermath brought circuit breakers and trading curbs that halt trading when markets fall too far too fast, guardrails that remain in place today. While the market eventually recovered, Black Monday became a stark warning about systemic risk in increasingly complex financial systems and how quickly millions of rational decisions can aggregate into collective madness. 8. The savings and loan crisis of the 1980s represents the moment when America decided deregulation was more important than financial stability. S&Ls were conservative institutions created to help ordinary Americans buy homes. In the early 1980s, Congress and the Reagan administration deregulated them, allowing these previously cautious mortgage lenders to invest in commercial real estate, junk bonds, and other high-risk ventures. The result was predictable. S&L executives with limited experience in complex investments made catastrophic decisions. When oil prices collapsed in the mid-1980s, the house of cards fell. Over 1,000 S&Ls failed, costing taxpayers $124 billion in bailouts, equivalent to about $300 billion today. The crisis revealed the dangers of removing regulations without understanding why they existed. While regulators strengthened oversight afterward, the fundamental lesson about the risks of financial deregulation would be forgotten by the early 2000s, setting the stage for the much larger 2008 financial crisis. 9. Japan's economic miracle transformed into a cautionary tale during the asset price bubble of the late 1980s. At its peak, the grounds of Tokyo's Imperial Palace were theoretically worth more than all the real estate in California. Stock valuations reached absurd levels, with price-to-earnings ratios exceeding 60 compared to historical norms of 15 to 20. The bubble was fueled by loose monetary policy, corporate cross-shareholding, and a belief that Japanese management practices had created a new economic paradigm, immune to Western-style recessions. When the Bank of Japan finally raised interest rates to cool speculation, the bubble burst spectacularly. The Nikkei stock index fell 60% from its 1989 peak of 38,915 to 14,309 by 1992, while urban land prices plummeted over 80% in major cities. The collapse triggered Japan's lost decades of economic stagnation and deflation. Despite near-zero interest rates and massive government spending, Japan's GDP in 2010 remained below its 1995 level, demonstrating how difficult recovery can be once a debt-fueled asset bubble collapses. 10. The dot-com bubble of the late 1990s demonstrated how even legitimate technological revolutions can trigger irrational financial manias. Companies with no profits and barely any revenue achieved multi-billion-dollar valuations simply by adding .com to their names. Pets.com went from IPO to liquidation in 268 days, burning through $300 million in venture capital and IPO proceeds to generate lifetime sales of just $47 million. The Nasdaq Composite Index rose from $1,000 to over $5,000 between 1995 and March 2000, then crashed 78% by October 2002, erasing $5 trillion in market value. What made the dot-com bubble particularly dangerous was the element of truth behind it. The internet did revolutionize business, just not quickly enough to justify the stratospheric valuations. When investors finally demanded actual profits instead of eyeballs and mindshare, reality reasserted itself brutally. While many dot-coms vanished, the crash cleared market excesses, allowing genuinely transformative companies like Amazon and eBay to emerge stronger, demonstrating capitalism's ability to eventually separate innovation from speculation. 11. Lehman Brothers' collapse on September 15, 2008, represents the moment when America's housing bubble finally burst in spectacular fashion. The 158-year-old investment bank had loaded up on mortgage-backed securities and real estate assets, borrowing over $30 for every $1 of its own capital. When U.S. housing prices began declining nationwide for the first time since the Great Depression, Lehman's assets plunged in value while its debts remained fixed. The Federal Reserve and Treasury Department, having already rescued Bear Stearns and nationalized Fannie Mae and Freddie Mac, decided to make Lehman an example of market discipline, a decision they would quickly regret. Lehman's bankruptcy filing with $613 billion in debt triggered a global financial seizure as banks worldwide stopped lending to each other, unsure which institution might collapse next. Within days, the government was forced to rescue AIG, implement massive market guarantees, and eventually pass the $700 billion TARP bailout to prevent a complete financial system collapse. The fallout demonstrated how deeply interconnected the global financial system had become, and how dangerous it is to let a major financial institution fail disorderly. 12. AIG's 2008 implosion transformed a state insurance company into a global financial catastrophe, requiring the largest corporate bailout in American history. The company's financial products division, employing just 400 people out of AIG's 116,000 global workforce, sold credit default swaps, essentially insurance policies on complex mortgage securities. The company collected premiums for years, considering default scenarios essentially impossible, according to their risk models. When the housing market collapsed, AIG suddenly owed billions to counterparties but lacked the cash to pay. The Federal Reserve stepped in with an unprecedented $182 billion bailout, effectively nationalizing the company. Why was AIG too big to fail? The insurance giant had become the central counterparty to Wall Street's mortgage casino. If AIG collapsed, it would trigger cascading failures across the global financial system. The rescue proved deeply unpopular with the American public, especially when AIG paid $165 million in executive bonuses after receiving taxpayer funds. The crisis revealed how a small division of a company could accumulate enough systemic risk to threaten the entire global economy. 13. Bear Stearns' sudden demise in March 2008 foreshadowed the financial crisis that would erupt 6 months later. The 85-year-old investment bank had survived the Great Depression and every subsequent financial crisis, building a reputation for smart risk-taking. By 2008, however, the firm had accumulated $33 of debt for every $1 of equity, much of it tied to subprime mortgages. When rumors about Bear's liquidity problems spread, clients and lenders pulled their funds in a modern-day bank run that unfolded at digital speed. In just 1 week, the company's available cash plummeted from $18 billion to less than $2 billion. Facing certain bankruptcy, Bear Stearns agreed to a Fed-orchestrated emergency sale to J.P. Morgan for $10 per share, down from $172 a year earlier, wiping out most shareholder value overnight. The collapse revealed how quickly market confidence can evaporate in the modern financial system and how devastating high leverage becomes when asset values decline. Most disturbingly, it demonstrated that even sophisticated financial institutions could suffer from old-fashioned bank runs, a vulnerability that would soon threaten the entire banking system. 14. Washington Mutual's 2008 collapse stands as the largest bank failure in American history. The Seattle-based thrift had transformed from a conservative regional lender into an aggressive nationwide mortgage machine, offering subprime loans and risky option-arm mortgages that allowed borrowers to pay less than the interest due each month. WAMU's CEO Kerry Killinger embraced a high-risk strategy, declaring in 2005, "We hope to do to this industry what Walmart did to theirs." By 2008, when housing prices began falling nationwide, WAMU's loan portfolio deteriorated rapidly. After Lehman Brothers' bankruptcy triggered widespread panic, depositors withdrew $16.7 billion in just 10 days, nearly 10% of WAMU's total deposits. Federal regulators seized the bank on September 25, 2008, and sold its assets to J.P. Morgan Chase for $1.9 billion. The shareholders and bondholders who had funded WAMU's expansion were wiped out completely. The bank's failure demonstrated how quickly depositor confidence can evaporate in a crisis, and how dangerous rapid growth can be when built on deteriorating lending standards. 15. Countrywide Financial's aggressive lending practices in the early 2000s helped inflate America's housing bubble to unprecedented levels. Under CEO Angelo Mazzillo, the company pioneered no-doc and low-doc loans that required minimal verification of borrowers' income or assets. By 2006, Countrywide had become America's largest mortgage lender, originating 1 in 5 U.S. home loans. The company's internal emails, later revealed in court documents, showed executives knew they were approving risky mortgages. Mazzillo himself described one Countrywide loan product as toxic and poison. As housing prices began falling in 2007, Countrywide's loan portfolio collapsed, forcing a fire sale to Bank of America for $4 billion in January 2008, a fraction of its former value. Bank of America would later pay over $50 billion in fines and settlements related to Countrywide's lending practices. Mazzillo eventually paid $67.5 million to settle SEC fraud charges but admitted no wrongdoing. Countrywide's rise and fall demonstrates how misaligned incentives in mortgage lending, where loan originators profited from volume rather than quality, created systemic risks that ultimately threatened the entire global financial system. 16. Iceland's 2008 banking collapse stands as the largest economic disaster in modern history relative to a country's size. In just 5 years, Iceland's 3 main banks, Kaupthing, Landsbanki, and Glitnir, had grown from modest institutions to international giants, with assets exceeding 900% of Iceland's GDP. These banks attracted deposits from across Europe, with high-interest accounts like Landsbanki's IceSave, while making aggressive acquisitions and loans. When global credit markets froze following Lehman Brothers' collapse, Iceland's banks couldn't refinance their short-term debt. Within a week in October 2008, all 3 banks failed. Iceland's currency, the krona, lost half its value almost overnight, while the stock market plunged 90%. The government couldn't possibly bail out banks nearly 10 times the size of the national economy. Instead, Iceland took unprecedented steps, letting the banks fail, guaranteeing only domestic deposits, imposing capital controls, and allowing its currency to crash. Remarkably, this approach worked better than many expected. By prioritizing social welfare over bank rescues, Iceland recovered faster than countries that bailed out their financial sectors, offering an alternative model for handling financial crises. 17. WorldCom's 2002 accounting scandal revealed the largest fraud in American corporate history to that point. The telecommunications giant, built through 65 acquisitions worth $60 billion in the 1990s, became America's second-largest long-distance provider. When the dot-com bubble burst and telecom growth slowed, CEO Bernie Ebbers refused to accept declining profits. The company's solution: simply pretend expenses were actually investments. WorldCom improperly capitalized $11 billion in ordinary operating expenses, allowing them to spread these costs over years rather than recognizing them immediately. This accounting magic transformed losses into paper profits. When internal auditor Cynthia Cooper discovered the fraud in 2002, WorldCom was forced to admit its deception. The company filed for bankruptcy in July 2002, wiping out $180 billion in shareholder value and 30,000 jobs. Ebbers was sentenced to 25 years in prison. The scale of WorldCom's fraud accelerated passage of the Sarbanes-Oxley Act, creating strict new standards for corporate governance and accountability. The case demonstrated how pressure to meet Wall Street expectations can drive even major corporations to commit outright fraud. 18. The Tyco scandal of the early 2000s exemplified the greed-is-good corporate excess that dominated the era. Under CEO Dennis Kozlowski, the industrial conglomerate spent billions acquiring companies while hiding excessive executive compensation from shareholders. Kozlowski and CFO Mark Schwartz awarded themselves $170 million in undisclosed bonuses and hundreds of millions in forgiven loans. Kozlowski became infamous for his extravagance, including a $2 million birthday party for his wife in Sardinia, featuring an ice sculpture of Michelangelo's David, urinating vodka, and a $6,000 shower curtain for his corporate apartment. The fraud unraveled in 2002, when a routine SEC investigation into a small accounting issue uncovered the massive self-dealing. Kozlowski and Schwartz were convicted of stealing $150 million and sentenced to 25 years in prison. The case highlighted how corporate governance failures allowed executives to treat public companies as personal piggy banks. It also demonstrated that prosecutors could successfully pursue white-collar criminals, helping restore investor confidence following the wave of corporate scandals that had undermined faith in American markets. 19. HealthSouth's $2.7 billion accounting fraud showed how a charismatic founder could turn a legitimate business into a criminal enterprise. Richard Scrushy built HealthSouth from nothing into the nation's largest provider of rehabilitation services, with 1,700 facilities across all 50 states. When the company began missing Wall Street's earnings expectations in 1996, Scrushy ordered his finance team to fix the numbers. For 7 years, they fabricated assets, invented cash, and manipulated over 120,000 accounting entries to inflate earnings. The scheme collapsed in 2003 when CFO William Owens, facing his own legal troubles, secretly recorded Scrushy discussing the fraud. 15 HealthSouth executives eventually pleaded guilty, but Scrushy himself was acquitted of federal charges in a controversial trial where he presented himself as a victim, betrayed by subordinates. He wasn't so lucky in civil court, where a judge ordered him to pay $2.9 billion to shareholders. The case demonstrated how extreme pressure to meet quarterly earnings targets can corrupt an entire corporate culture, and how charismatic leaders can intimidate employees into participating in fraudulent schemes. 20. Parmalat's 2003 collapse revealed that massive financial fraud wasn't just an American phenomenon. The Italian dairy giant had transformed from a small pasteurization plant into a multinational corporation operating in 30 countries. According to its financial statements, Parmalat was extraordinarily profitable and held $4 billion in liquid assets at Bank of America. The reality? The company was deeply indebted, and the bank account didn't exist. It was created with a scanner, scissors, and glue. When Parmalat couldn't pay a relatively modest $150 million bond payment in December 2003, the entire scheme unraveled. Investigators discovered a $14 billion hole in the company's accounts, equivalent to 1% of Italy's GDP. Founder Callisto Tanzi had diverted company funds to family businesses while hiding losses through a network of offshore entities. Tansey was sentenced to 18 years in prison for financial fraud. The scandal became known as Europe's Enron, prompting the European Union to strengthen its financial regulations. Parmalat's collapse demonstrated that accounting fraud could happen anywhere, especially in family-controlled businesses with weak corporate governance. 21. Arthur Andersen's 2002 destruction wasn't just the end of an 89-year-old accounting firm. It was the death of a once sterling professional reputation. Founded in 1913, Andersen built its business on integrity, rejecting a client in the 1920s with the famous line, "There is not enough money in the city of Chicago to induce this firm to sign a report that is not true." By 2001, this commitment had faded as consulting revenue eclipsed traditional accounting fees. When Enron's fraud began to emerge, Andersen partners shredded tons of documents related to the energy giant's audits. This obstruction of justice led to a criminal conviction that automatically barred Andersen from auditing public companies. Overnight, the firm's 85,000 employees worldwide faced unemployment. Though the Supreme Court later overturned the conviction on technical grounds, it came too late. The firm had already collapsed. Andersen's demise served as a stark warning to the accounting profession about the consequences of prioritizing consulting fees over audit integrity, and demonstrated how quickly professional reputations built over decades can be destroyed by ethical failures. 22. Theranos' $9 billion fraud demonstrated how Silicon Valley's fake-it-till-you-make-it culture can cross into criminal territory. Elizabeth Holmes founded the blood testing startup at age 19, claiming her technology could run hundreds of tests from a few drops of blood. Despite never publishing in peer-reviewed journals or allowing independent verification, Holmes raised $945 million from investors, assembled a political heavyweight board including 2 former secretaries of state, and achieved a $9 billion valuation. Behind the scenes, Theranos was using commercial analyzers for most tests, while its proprietary Edison machines produced wildly inaccurate results. The facade cracked in 2015, when Wall Street Journal reporter John Carreyrou published an investigation exposing the technology's failures. By 2018, the company had dissolved. Holmes was eventually sentenced to 11 years in prison for defrauding investors. The Theranos scandal revealed dangerous blind spots in venture capital due diligence, particularly for technically complex startups. It demonstrated how charismatic founders wielding impressive but vague technological claims can circumvent normal scientific scrutiny, especially when playing to investors' fear of missing the next big thing. 23. The FTX cryptocurrency exchange collapse in November 2022 stands as crypto's defining financial disaster. Founder Sam Bankman-Fried, SBF, built FTX into the world's second-largest crypto exchange, valued at $32 billion, while presenting himself as the industry's responsible face. Behind the scenes, FTX was allegedly funneling customer funds to SBF's hedge fund, Alameda Research, which used the money for risky investments, political donations, and luxury real estate purchases. When rival exchange Binance threatened to liquidate its FTX tokens, customers rushed to withdraw funds, exposing an $8 billion hole in FTX's accounts. The exchange filed for bankruptcy on November 11, 2022, while SBF's $16 billion fortune evaporated. Federal prosecutors charged him with fraud, conspiracy, and campaign finance violations. FTX's spectacular failure highlighted fundamental problems in cryptocurrency: insufficient regulation, extreme conflicts of interest, and a culture that valued growth and hype over sustainable business practices. It reminded investors of the timeless lesson that when someone offers exceptional returns with seemingly minimal risk, extreme skepticism is warranted, especially when their business operates in regulatory gray zones. 24. Terra Luna's May 2022 collapse demonstrated how quickly mathematical certainty can dissolve into financial catastrophe. The cryptocurrency project centered around 2 tokens, Luna and Terra USD, UST, a stablecoin supposedly worth exactly $1. Unlike other stablecoins backed by actual dollars, UST maintained its peg through an algorithmic relationship with Luna. Users could always swap 1 UST for $1 worth of newly created Luna tokens. This system worked fine while confidence remained high. But when large holders began selling UST in May 2022, the peg slipped. The algorithm responded by printing more Luna tokens, diluting their value. This triggered a death spiral. As Luna's price fell, more Luna had to be created to maintain UST's dollar peg, driving Luna's price down further. Within days, Luna's price crashed from $80 to nearly zero, while UST collapsed to 0.10. The twin collapses wiped out $60 billion in market value, comparable to the Enron or WorldCom frauds. Terra's implosion demonstrated the fragility of algorithmic financial systems that work until they suddenly don't, and how mathematical elegance can create a false sense of security that masks catastrophic systemic risks. 25. WeWork's epic rise and fall embodied the excesses of the 2010s startup boom. Founded by charismatic Adam Neumann, the office-sharing company expanded to 528 locations across 111 cities, achieving a $47 billion private valuation by 2019. Neumann promoted WeWork not as a real estate company but as a physical social network and community company deserving of a tech company valuation multiple. SoftBank CEO Masayoshi Son encouraged this growth at all costs strategy, pouring billions into the company. Reality struck when WeWork filed for its IPO in August 2019. Public investors saw what private investors had ignored. WeWork lost $1.9 billion on $1.8 billion in revenue in 2018 and had no clear path to profitability. The filing also revealed Neumann's conflicts of interest, including personally buying properties and leasing them back to WeWork. Within 6 weeks, WeWork's valuation plummeted to $8 billion, Neumann was forced out, and the IPO was canceled. The debacle demonstrated the dangers of unlimited private capital combined with imperial founders and compliant boards, and it marked a turning point where public markets finally rejected the growth without profits model that had dominated venture capital for a decade. 26. Quibi's spectacular $15 billion failure in 2020 demonstrated that even Hollywood and Silicon Valley royalty can badly misread consumer preferences. Founded by former Disney executive Jeffrey Katzenberg and former HP CEO Meg Whitman, the streaming service aimed to revolutionize mobile entertainment with quick bites of premium content, each under 10 minutes. Despite raising nearly $2 billion and attracting A-list talent, Quibi shut down just 6 months after launching. What went wrong? Quibi made multiple strategic errors. Launching during a pandemic when few people were commuting, a key use case, prohibiting screenshots, blocking social sharing, offering no TV viewing option initially, and charging $5.08 monthly when competitors offered more content for similar prices. Most fundamentally, Quibi failed to recognize that short-form video was already dominated by free user-generated content on platforms like TikTok and YouTube. After burning through most of its capital, Quibi returned about $350 million to investors. The venture illustrated how easily even experienced executives can waste vast sums when they build products based on untested assumptions rather than genuine consumer insights, and how traditional media credentials don't necessarily translate to digital platform success. 27. Wirecard's spectacular fraud demonstrates how regulatory failures and national pride can enable massive financial deception. The German payment processor claimed to process transactions for clients worldwide, reporting ever-increasing profits that made it a darling of European financial markets. By 2018, Wirecard had replaced Commerzbank in Germany's prestigious DAX 30 index, achieving a $24 billion valuation. Behind the facade lay an elaborate global fraud. When journalists and short sellers questioned Wirecard's accounting, German financial regulator BaFin defended the company, even filing criminal complaints against the critics. The Financial Times persisted with its investigation, eventually revealing that $1.9 billion supposedly held in Philippine bank accounts simply didn't exist. CEO Marcus Braun was arrested, while COO Jan Marsalek disappeared and remains a fugitive, reportedly hiding in Russia with possible intelligence connections. Wirecard's June 2020 collapse shocked German markets and embarrassed BaFin, which had viewed the company as a rare German tech success story worth protecting. The scandal demonstrated how national pride can blind regulators to fraud within their borders, and how excessive deference to corporate management can allow massive financial crimes to continue years after initial warnings appear. 28. Nikola's hydrogen truck fiasco illustrated how the SPAC boom created perfect conditions for questionable companies to access public markets. Founded by Trevor Milton in 2014, the company promised to revolutionize trucking with hydrogen-powered semi-trucks. Nikola went public in June 2020 through a SPAC merger, briefly reaching a $34 billion valuation, higher than Ford's at the time, despite having zero revenue. The hype peaked when General Motors announced a $2 billion partnership with Nikola. Then, short seller Hindenburg Research published a devastating report titled, "Nikola, How to Parlay." An ocean of lies into a partnership with the largest auto OEM in America. The report's most damning revelation, a promotional video showing Nikola's prototype truck, in motion, was actually filming the vehicle rolling downhill after being towed to the top of a slope. Milton resigned in September 2020, and in 2022 was convicted of securities fraud. By then, Nikola's stock had collapsed by 98% from its peak. The fiasco exemplified how SPACs' lighter disclosure requirements compared to traditional IPOs created opportunities for questionable companies to access public markets, and how charismatic founders could leverage the market's enthusiasm for green technology to achieve stratospheric valuations without viable products. 29. The GameStop short squeeze of January 2021 demonstrated how retail investors could organize online to create financial havoc for Wall Street institutions. GameStop, a struggling video game retailer, had become a target for short sellers betting on its decline. Users of Reddit's Wall Street Bets forum, believing the stock was undervalued and spotting unusually high short interest, began buying shares and call options en masse. As GameStop's stock rose from around $20 to a peak of $483 in days, hedge funds with short positions faced catastrophic losses. Melvin Capital, which had heavily shorted GameStop, lost 53% of its value in January 2021 alone, requiring a $2.75 billion bailout from other hedge funds. The squeeze intensified when retail trading platform Robinhood restricted buying of GameStop and other meme stocks on January 28, claiming clearinghouse capital requirements forced their hand. The restrictions triggered outrage among retail traders and rare bipartisan condemnation from politicians. While GameStop eventually fell back below $100, the episode permanently altered Wall Street's approach to short selling and demonstrated the power of social media to coordinate retail investors into a market-moving force. Melvin Capital never recovered and announced its closure in May 2022, marking one of the most significant hedge fund failures triggered by retail investors. 30. Archegos. Capital's 2021 implosion revealed alarming blind spots in financial regulation. Bill Huang, previously barred from the hedge fund industry for insider trading, quietly built an estimated $100 billion position in a handful of stocks using total return swaps, derivatives that gave him economic exposure without disclosure requirements. By using multiple banks and extreme leverage, in some cases borrowing $85 for every $1 of his own capital, Huang accumulated massive positions in companies like Viacom, CBS, and Discovery while keeping his name out of SEC filings. When these stocks declined in March 2021, banks issued margin calls that Archegos couldn't meet. The banks then simultaneously liquidated the same stocks, accelerating price declines and amplifying their collective losses. Credit Suisse lost $5.5 billion, Nomura, $2.9 billion, and Morgan Stanley $911 million. Remarkably, neither the SEC nor the banks themselves knew the full extent of Huang's positions across different institutions. The Archegos disaster highlighted dangerous regulatory gaps, allowing family offices to evade reporting requirements, and revealed how competition among prime brokers for lucrative clients led them to extend dangerous levels of leverage while conducting inadequate due diligence. 31. Three Arrows. Capital's 2022 collapse epitomized the interconnected risks of the cryptocurrency ecosystem. Founded in 2012 as a traditional currency trading fund, 3AC pivoted to crypto and became one of the industry's most prominent investments. Firms. Co-founders Sue Ju and Kyle Davies built a reputation as sophisticated investors while amassing positions worth billions in Bitcoin, Ethereum, and various DeFi projects. Their downfall began with a massive investment in Luna, which imploded in May 2022, costing 3AC an estimated $500 million. Rather than acknowledging these losses, the firm allegedly continued borrowing and investing as if nothing had happened. When cryptocurrency prices broadly declined in June 2022, lenders discovered that 3AC couldn't meet margin calls on its estimated $18 billion in borrowings. The fund filed for bankruptcy, owing creditors more than $3.5 billion. The implosion triggered a domino effect, contributing to the failure of crypto lenders Celsius and Voyager Digital, who had extended uncollateralized loans to 3AC. Court filings later revealed that Zhu and Davies had purchased luxury yachts and properties with company funds before the collapse. The 3AC disaster demonstrated cryptocurrency's lack of circuit breakers, risk controls, and regulatory oversight while showing how quickly contagion can spread through an unregulated financial ecosystem built on leverage and opacity. 32. Celsius Network's 2022 bankruptcy revealed the dangers lurking behind promises of bank-beating crypto returns. Founded in 2017, Celsius offered users up to 18% annual yield for depositing cryptocurrencies on its platform, far higher than traditional bank interest rates. By May 2022, the company claimed over $20 billion in assets and 1.7 million users. Behind this growth was a business model resembling a traditional bank, but without the regulation. Celsius took user deposits, made risky loans and investments with those funds, and pocketed the difference between investment returns and interest paid to depositors. When cryptocurrency prices crashed in mid-2022, Celsius faced a liquidity crisis as users rushed to withdraw funds. On June 12, 2022, the company froze all withdrawals and a month later filed for bankruptcy, revealing a $1.2 billion hole in its balance sheet. Court documents showed that while founder Alex Mashinsky was publicly reassuring customers, he and other executives were privately withdrawing $42 million of their own funds. The collapse demonstrated how crypto companies were recreating the same risks that banking regulations were designed to prevent, with customers discovering too late that they were effectively unsecured creditors rather than depositors with protected funds. 33. CNN Plus stands as one of the most expensive media failures in history, lasting just 32 days despite consuming over $300 million. Launched on March 29, 2022, the streaming service aimed to extend CNN's brand with original programming featuring stars like Anderson Cooper and Eva Longoria. What CNN executives didn't anticipate was that their parent company, Warner Media, would complete a merger with Discovery just weeks after the launch, bringing in new management with different streaming priorities. The new Warner Bros. Discovery leadership, led by CEO David Zaslav, was pursuing a strategy of combining all the company's content into a single streaming platform, later named Max. CNN Plus had attracted only about 150,000 subscribers paying $5.99 monthly, far short of the 2 million first-year subscribers executives had projected. With CNN Plus burning $400,000 daily and facing a challenging path to profitability, the new management pulled the plug on April 30, 2022. The debacle demonstrated the risks of launching major initiatives during corporate transitions and the dangers of building business plans around consumer behavior predictions without adequate market testing. 35. The Silicon Valley Bank collapse of 2023 offers a masterclass in how to destroy a 40-year-old financial institution in just 48 hours. SVB had loaded up on long-term government bonds when interest rates were near zero, apparently missing the memo that rates might someday rise. When the Federal Reserve hiked rates aggressively to fight inflation, those bonds lost value faster than a snowman in July. Meanwhile, the bank's tech startup clients began burning through cash as venture funding dried up. When SVB announced a $1.8 billion loss from selling bonds to shore up liquidity, panicked customers coordinated the first digital bank run in history via Twitter and Slack. In just one day, depositors tried to withdraw $42 billion, a quarter of the bank's deposits. Regulators stepped in and closed SVB the next morning, making it the second-largest bank failure in U.S. history. The spectacular implosion demonstrated how modern technology has transformed the classic bank run from a slow-motion disaster into a lightning-fast execution. 36. In 2008, Microsoft CEO Steve Ballmer offered Yahoo $44.6 billion to acquire the struggling internet pioneer, a 62% premium over its stock price. Yahoo's co-founder and CEO Jerry Yang convinced his board this was an insult, claiming the company was worth at least $53 billion. In a textbook case of negotiation malpractice, Yang never made a serious counteroffer, essentially telling Microsoft to get lost. When Ballmer raised the bid to $47.5 billion, Yang still wouldn't engage. Microsoft walked away, and Yahoo's stock collapsed. Yang was forced out months later as shareholders revolted. After cycling through 5 CEOs in 5 years, Yahoo eventually sold its core business to Verizon in 2017 for just $4.8 billion, about 10% of Microsoft's original offer. The saga stands as perhaps the most expensive case of founders' pride in corporate history, destroying roughly $40 billion in shareholder value. It's a sobering reminder that when someone offers you 62% more than your company is worth, sometimes the correct response is, "Thank you," rather than, "How dare you." 37. Kodak's journey from innovation to irrelevance represents one of the most spectacular examples of corporate denial in business history. In 1975, Kodak engineer Steve Sasson invented the world's first digital camera, a toaster-sized contraption capturing black and white images at 0.01 megapixels. When he demonstrated it to Kodak executives, their response was essentially, "That's cute, now hide it." Why? Because Kodak made 70% of its profits from selling film, and digital photography threatened that golden goose. For decades, Kodak suppressed its own digital technology while Japanese competitors embraced it. By the time Kodak finally accepted the digital revolution in the late 1990s, it was too late. The company that had once employed 145,000 people filed for bankruptcy in 2012. The irony? At its peak, Kodak held over 90% of the US film market and 85% of camera sales. They literally had the resources and talent to lead the digital transformation they themselves had pioneered. Instead, they chose comfortable denial over painful adaptation, becoming the textbook example of what innovation experts now call the Kodak moment, that fatal instant when a company chooses to protect its past rather than embrace its future. 38. In 2000, Blockbuster CEO John Antioco met with Netflix founders Reed Hastings and Mark Randolph, who proposed that Blockbuster buy their fledgling DVD by mail service for $50 million. According to company lore, Antioco nearly laughed them out of the room, viewing Netflix as a niche player in a market Blockbuster dominated with 9,000 stores and 60,000 employees. Blockbuster's executives couldn't imagine how mailing DVDs could possibly compete with the immediate gratification of their store experience. By the time Blockbuster realized its mistake and tried launching its own subscription service in 2004, Netflix had established a commanding lead. When Netflix began streaming content in 2007, Blockbuster was still focused on physical stores. In 2010, Blockbuster filed for bankruptcy, while Netflix continued its meteoric rise. Today, Netflix is worth over $150 billion, 3,000 times what they asked Blockbuster to pay. The tale has become Silicon Valley's favorite cautionary story about incumbents dismissing disruptors. It perfectly captures how market leaders often fail, not because they ignore new technologies, but because they can't imagine how those technologies might completely reshape customer expectations and behavior. 39. In the 1970s, Xerox PARC, Palo Alto Research Center, invented practically the entire modern computing experience. The graphical user interface, the mouse, WYSIWYG word processing, Ethernet networking, and the laser printer. Then, in what may be the greatest corporate gift in history, Xerox essentially gave these innovations away. When Steve Jobs visited PARC in 1979, Xerox executives allowed him to tour their labs and see their revolutionary Alto computer in action. Jobs immediately grasped the significance of what he'd seen, famously exclaiming, "Why isn't Xerox marketing this?" He promptly redirected Apple's efforts to incorporate PARC's innovations into what would eventually become the Macintosh. Xerox did attempt to commercialize these technologies with the Xerox Star workstation, but priced it at $16,500, $50,000 today, and marketed it poorly. While Xerox focused on its lucrative copier business, Apple and Microsoft built trillion-dollar empires on the foundations Xerox had pioneered. The painful lesson? Innovation without commercialization is just expensive philanthropy. Xerox's engineers invented the future, but its executives couldn't see beyond the next copier sale, creating perhaps the most expensive missed opportunity in business history. 40. The AOL-Time Warner merger stands as the Mount Everest of corporate hubris, the largest, most visible disaster in merger history. In January 2001, at the peak of dot-com mania, Internet service provider AOL used its inflated stock to purchase media giant Time Warner for $165 billion. AOL's Steve Case proclaimed it would create the company of the 21st century, combining Time Warner's content with AOL's online distribution. What could possibly go wrong? Everything. The dot-com bubble burst almost immediately after the deal closed. Corporate cultures clashed viciously, with AOL's aggressive sales force alienating Time Warner's more traditional media executives. Promised synergies never materialized as dial-up internet was rapidly replaced by broadband. By 2002, the combined company wrote down its assets by a staggering $99 billion, the largest such write-down in corporate history. AOL's market value, $226 billion at merger, collapsed to under $20 billion. The carnage was so complete that Time Warner eventually spun off AOL in 2009 for just $2.5 billion. The deal destroyed approximately $200 billion in shareholder value, or roughly the GDP of New Zealand. It remains business school's favorite case study in how not to merge companies, especially when one partner's valuation is built on technological assumptions that can change overnight. 41. In 1962, Decca Records made what's widely considered the worst decision in music history. After auditioning the Beatles, Decca's A&R representative Dick Rowe rejected them, reportedly telling their manager Brian Epstein, "Guitar groups are on the way out, Mr. Epstein." Instead, Decca signed Brian Poole and the Tremolos, who had auditioned the same day. Within 18 months, the Beatles would unleash Beatlemania worldwide, selling 600 million records during their active years. While Decca's blunder has become legendary, the full story is more nuanced. The Beatles' audition wasn't particularly impressive. They were nervous and played mostly covers rather than Lennon-McCartney originals. And Rowe, unfairly branded as the man who rejected the Beatles, later signed the Rolling Stones, partly on George Harrison's recommendation. Still, the decision ranks among history's greatest missed opportunities. The Beatles would go on to revolutionize popular music and culture while generating billions in revenue. Decca's rejection demonstrates how easy it is for even experienced professionals to miss transformative talent when it doesn't fit their preconceptions about where the market is heading. Sometimes the biggest opportunities arrive looking nothing like what you expect. 42. In 1981, Universal Studios approached Mars Inc. with a sweet product placement opportunity. Their newest film needed a colorful candy that an alien could follow in a trail. Mars, makers of M&Ms, declined, apparently concerned about associating their product with an alien character. Universal then approached Hershey, offering the same opportunity for their newly acquired Reese's Pieces brand. Hershey agreed, committing to a $1 million promotional campaign for the film, without even seeing the script. That film was E.T. the Extraterrestrial, which became the highest-grossing movie of all time to that point. Within 2 weeks of the film's release, Reese's Pieces sales reportedly jumped 65%, and within months had tripled. The exposure transformed a relatively new candy into a cultural phenomenon, one that continues to benefit from the association over 40 years later. Mars executives could only watch as their competitor reaped the rewards of one of the most successful product placements in film history. The blunder illustrates how conservative corporate thinking can miss golden opportunities that require little investment but offer massive potential returns. Sometimes the most profitable decision is simply saying yes when serendipity knocks on your door, especially when the alternative is watching your competitor say yes instead. 43. In 2011, Netflix CEO Reed Hastings went from streaming visionary to corporate punchline by making the most tone-deaf business announcement in recent memory. First, Netflix hiked prices by 60% by separating streaming and DVD subscriptions. Then came the real disaster. Hastings announced they would split the company entirely, renaming the DVD service Quickster, requiring customers to maintain separate accounts, queues, and billing relationships for what had been a seamless service. The customer backlash was immediate and furious. Netflix lost 800,000 subscribers in a single quarter, and its stock collapsed from $300 to $63. Just 3 weeks after announcing Quickster, Hastings killed it without ever launching, admitting, "I slid into arrogance based upon past success." The humiliating reversal worked. Netflix refocused on streaming, international expansion, and original content, eventually becoming an entertainment powerhouse. Today, the Quickster fiasco is studied as a near-perfect example of how not to implement a business transition, but also as a rare case where a CEO's willingness to quickly acknowledge a terrible decision saved a company from self-destruction. Sometimes the best thing a leader can do is admit they were completely, embarrassingly, wrong. 44. When Apple retail wizard Ron Johnson became JCPenney's CEO in 2011, he arrived with a dramatic vision to reinvent the struggling department store. His first major move? Eliminating all sales, coupons, and clearance events in favor of everyday low prices. Johnson believed customers would appreciate honest pricing rather than the artificial markdown game other retailers played. He was catastrophically wrong. JCPenney's core customers, trained for decades to hunt for deals and use coupons, abandoned the store in droves. Revenue plummeted 25% in a single year, a $4.3 billion drop. Johnson also removed cash registers, eliminated commission for salespeople, and rearranged store layouts without testing these changes. The board fired Johnson after just 17 months, but the damage was done. JCPenney never recovered, eventually filing for bankruptcy in 2020. The debacle offers a painful lesson in customer psychology. Consumers often prefer the emotional satisfaction of getting a deal, even if it's manufactured, over actually paying less. Johnson's mistake wasn't trying to transform JCPenney, the company needed radical change, but rather assuming he could instantly re-educate customers who had been conditioned for generations to shop a certain way. 45. Radio Shack's descent from ubiquitous electronics retailer to bankruptcy punchline represents one of retail's most predictable yet unstoppable collapses. Founded in 1921 to serve radio operators, the company expanded to nearly 7,000 stores by the 1990s. But as consumer electronics evolved, Radio Shack remained trapped in a strategic no man's land, too specialized to compete with big box retailers like Best Buy, yet too corporate to capture the enthusiast market they had originally served. The company made multiple failed attempts at reinvention, selling mobile phones, which cannibalized higher-margin products, computers, which they couldn't properly support, and even random items like toy helicopters. While executives recognized the threats from online retailers, they never developed a coherent digital strategy. By the time Radio Shack filed for bankruptcy in 2015, its stores had become retail museums, places where older customers went for obscure electronic parts while younger consumers shopped online. The company's slogan, "You've got questions, we've got answers," became increasingly ironic as management failed to answer the most important question. What is Radio Shack's reason to exist in the digital age? Their inability to find a compelling answer led to the once innovative retailer's slow-motion collapse. 46. The demise of Sears, once America's largest retailer, represents perhaps the slowest, most painful example of corporate suicide in business history. In the early 1990s, Sears actually pioneered e-commerce with Prodigy, an online service joint venture with IBM. They created an early online marketplace years before Amazon existed. But when hedge fund manager Eddie Lampert gained control in 2005, he implemented a disastrous strategy, dividing Sears into over 30 separate units that competed against each other for resources. While Lampert focused on financial engineering and stock buybacks, Amazon was investing billions in its platform. Sears' physical stores deteriorated as maintenance budgets were slashed. The company spent just $2 per square foot on store maintenance versus $6-8 for competitors, creating a depressing shopping experience. Meanwhile, its online presence remained anemic, with less than 0.5% of the e-commerce market. After years of declining sales, Sears finally filed for bankruptcy in 2018, closing most of its stores. The stunning collapse of an American retail icon that survived 2 world wars and the Great Depression but couldn't survive its own leadership illustrates how even companies with tremendous advantages can fail when they refuse to invest in the future. 47. In 2007, BlackBerry co-CEO Mike Lazaridis dismissed the just-announced iPhone, declaring, "It's okay, but it's not secure. It's like giving a kid a gun without teaching him how to use it." At the time, BlackBerry dominated the smartphone market with its secure messaging and physical keyboard. The company's other co-CEO, Jim Balsillie, similarly scoffed, "It's kind of one more entrant into an already very busy space with lots of choice for consumers." But in terms of a sort of a sea change for BlackBerry, I would think that's overstating it. Their dismissal of Apple's touchscreen toy proved catastrophically misguided. BlackBerry's market share collapsed from 50% in 2009 to less than 1% by 2016 as consumers embraced the iPhone and Android devices. The company failed to recognize how dramatically consumer preferences would shift toward browsing, apps, and media consumption over BlackBerry's strengths in security and email. By the time BlackBerry launched its own touchscreen phone in 2013, the market had moved on. The company that once defined the smartphone category eventually abandoned hardware entirely to focus on software and services. BlackBerry's failure demonstrates how even technical visionaries can become blind to shifts in consumer priorities when they're too focused on the features they personally value rather than watching how user behavior is evolving. 48. In the late 1990s, General Motors created something remarkable, an electric vehicle that customers actually loved. The EV1 was sleek, fast, and emissions-free, with passionate lessees who formed emotional connections with their cars. When California's zero-emissions mandate was weakened in 1999, GM made an astonishing decision. Rather than sell the cars to their eager lessees, the company reclaimed and destroyed nearly all 1,100 EV1s, crushing them and sending them to the shredder despite pleas from customers offering to buy them at any price. GM claimed the cars couldn't be sold due to liability concerns and parts availability issues. Critics saw a more cynical motive: protecting GM's profitable internal combustion engine business from proof that viable electric alternatives existed. The company's decision became the subject of the documentary Who Killed the Electric Car? And a PR disaster that painted GM as actively suppressing clean technology. The short-term thinking proved especially costly in the long run. GM abandoned EV development for years, while Toyota captured the green vehicle market with its hybrid Prius. When GM finally returned to electrification with the Chevy Volt and later the Bolt, they were playing catch-up in a market they had once led. 49. The demise of Pan American World Airways provides a textbook case of how to dismantle a legendary company one bad decision at a time. In 1985, facing financial pressure, Pan Am sold its Pacific routes to United Airlines for $750 million to generate quick cash. These routes, built over decades, had been among the airline's most profitable assets. The sale proved catastrophic, as Pan Am lost a critical source of revenue and network connectivity while merely postponing its financial problems. The airline then made a second strategic blunder, purchasing National Airlines for $437 million to strengthen its domestic presence. The acquisition created route redundancies, culture clashes and fleet incompatibilities that drained Pan Am's remaining resources. When the 1988 terrorist bombing of Flight 103 over Lockerbie, Scotland, devastated passenger confidence in the airline, Pan Am lacked the financial strength to weather the crisis. The once dominant carrier that had symbolized American global reach for half a century filed for bankruptcy in 1991 and ceased operations entirely in December that year. Pan Am's collapse demonstrates how selling core strategic assets for short-term cash relief rarely solves fundamental business problems and often accelerates a company's decline by removing its most valuable competitive advantages. 50. Eastern Airlines' response to airline deregulation in 1978 represents a case study in how rigid leadership can destroy a once great company. Under former astronaut Frank Borman's command, Eastern faced a new competitive landscape where upstarts like People Express offered dramatically lower fares. Instead of adapting Eastern's cost structure to compete, Borman focused on extracting wage concessions from Eastern's unionized workforce, creating an increasingly toxic labor environment. The airline pioneered variable pricing and a frequent flyer program, but these innovations were undermined by deteriorating service as labor relations worsened. The situation reached its breaking point when Borman sold Eastern to Frank Lorenzo, notorious for his union-busting tactics at Continental Airlines. Eastern's unions, fearing similar treatment, launched devastating strikes in 1989. With pilots and machinists on the picket lines rather than in cockpits and maintenance hangars, the airline's operations collapsed. Eastern filed for bankruptcy and attempted to continue flying with replacement workers, but the damage was irreparable. The once proud carrier that had connected the Eastern seaboard since 1926 ceased operations in January 1991. Eastern's demise illustrated how failure to adapt to industry transformation, combined with scorched earth labor relations, can turn fixable challenges into terminal conditions. 51. The Pets.com saga epitomizes the irrational exuberance of the dot-com bubble in 56 words. The company spent $11.8 million on a Super Bowl ad featuring a sock puppet while losing money on virtually every sale. Founded in 1998, Pets.com raised $82.5 million in its February 2000 IPO, despite having no path to profitability. Their business model was fundamentally flawed. Shipping 50-pound bags of dog food at a loss isn't sustainable no matter how cute your mascot. The company burned through $300 million in investment capital in less than 2 years, going from IPO to liquidation in just 9 months. By November 2000, the company that had once traded at $14 per share was selling its assets at bankruptcy auction. The sock puppet, ironically, proved more valuable than the business model, eventually being purchased by Bar None, a loan company. Pets.com's spectacular flameout became the perfect symbol of dot-com excess. Massive marketing expenditure, non-existent profitability, and investors so desperate to participate in the internet revolution that they abandoned basic business logic. 52. Webvan's spectacular burnout in the early 2000s demonstrated how even legitimate business ideas can fail when executed with reckless abandon. The online grocery delivery service raised a staggering $800 million from investors, including $375 million in its November 1999 IPO. Webvan's ambitious plan? Build automated warehouses in 26 cities over 18 months, each costing $35 million. Rather than testing the model in one market before expanding, founder Louis Borders insisted on simultaneous national rollout. The company built massive infrastructure before proving customer demand, spending lavishly on everything from custom-designed delivery trucks to executive perks. When demand fell far short of projections and the dot-com bubble burst, Webvan's cash burn became unsustainable. The company declared bankruptcy in July 2001, having blown through $800 million to generate lifetime revenue of just $178 million. The irony? Webvan's core concept was sound, as proven by today's successful grocery delivery services. But by prioritizing rapid growth over sustainable economics, the company ensured its own destruction. Nearly 2 decades later, Amazon purchased Whole Foods and implemented a grocery delivery model remarkably similar to Webvan's, but with the patience and capital to make it work. 53. eToys' rapid rise and even faster fall perfectly captures how the dot-com bubble turned reasonably good businesses into spectacular train wrecks. Founded in 1997, the online toy retailer generated $30 million in revenue in its first year. Impressive for an internet startup at the time. When the company went public in May 1999, investors went wild, driving the stock from its $20 offering price to $76 on the first day of trading, giving eToys a market capitalization of $7.7 billion, or about 35 times its annual revenue. By comparison, Toys R Us, with 9,500 physical stores and $11.2 billion in revenue, was valued at just $6 billion. This absurd valuation created impossible expectations. Then came Christmas 1999, when eToys' fulfillment systems buckled under holiday demand, resulting in late deliveries and customer complaints. Worse, the company had massively overstocked inventory in anticipation of even higher sales. When the dot-com bubble began deflating in early 2000, eToys' stock collapsed. By the 2000 holiday season, the company was desperately slashing prices to generate cash. But it was too late. eToys filed for bankruptcy in March 2001, its assets eventually selling for just $5.7 million. 54. The Segway personal transporter represents one of history's greatest gaps between hype and reality. Before its December 2001 unveiling, the mysterious invention had technology luminaries buzzing. Steve Jobs predicted it would be as significant as the PC, while venture capitalist John Doerr claimed it would reach $1 billion in sales faster than any company in history. Amazon founder Jeff Bezos supposedly fell to his knees after seeing it. When inventor Dean Kamen finally revealed his creation on Good Morning America, expectations were stratospheric. The two-wheeled, self-balancing electric vehicle was indeed an engineering marvel, but it faced monumental challenges. The $5,000 price tag, regulatory confusion about whether it belonged on sidewalks or roads, and the simple fact that most people felt self-conscious riding it. Kamen predicted Segway would sell 10,000 units weekly. By 2015, the company had sold about 140,000 total in its entire history. The product that was supposed to revolutionize urban transportation ended up primarily used by mall cops, tourists on guided city tours, and as a punchline in the comedy film Paul Blart Mall Cop. In 2010, the company's new owner, British entrepreneur Jimmy Heselden, tragically died after accidentally driving his Segway off a cliff. A sadly fitting metaphor for the product's business trajectory. 55. Google Glass perfectly demonstrates how even brilliant technologists can completely misjudge social acceptance. Unveiled in 2013, the $2,500 augmented reality glasses projected information into the wearer's field of vision and could record video. Features Google expected would revolutionize how we interact with technology. What Google failed to anticipate was the immediate social backlash. People being recorded without consent coined the term glass hole for wearers. Bars and restaurants banned the devices. Privacy concerns mounted. Even early adopters felt self-conscious, wearing something that screamed, "I'm recording you," and also paid $1,500 to look like a cyborg. Within 18 months, Google pulled Glass from the consumer market, having learned an expensive lesson about the social dimensions of wearable technology. The product later found niche success in enterprise applications like factory floors and medical settings, environments where function trumps fashion and privacy concerns are minimal. Google's experience with Glass showed that technical capability alone doesn't guarantee product success, especially when that product sits on users' faces and changes how they interact with others. Sometimes the most important product testing isn't about whether something works, but whether wearing it makes people want to punch you in the face. 56. Microsoft's Zune represents one of the most expensive Me Too product failures in tech history. Launched in 2006, Microsoft's portable media player arrived 5 years after Apple's iPod had already revolutionized the market. Despite spending billions on development and marketing, including a $100 million launch campaign, the Zune never captured consumer imagination. The first-generation device was criticized for being bulkier than the iPod and only available in brown, mockingly described as the color of, well, you know. While later models improved technically, the Zune remained shackled to Microsoft's music ecosystem in a world dominated by iTunes. Even the Zune's genuinely innovative features like wireless music sharing were hobbled by restrictions. Shared songs could only be played 3 times before being deleted. Sales were disastrous. Microsoft never released exact figures, but analysts estimated the Zune captured less than 2% market share at its peak. The company finally discontinued the product in 2011, with former Microsoft exec Robbie Bach later admitting they were just chasing Apple. The Zune fiasco demonstrated how even limitless resources can't overcome fundamental strategic problems. Entering a market too late, with a product too similar, against an entrenched competitor who already owns the customer relationship. 57. HP's touchpad offers a masterclass in how to waste $1 billion and destroy a promising product in just 49 days. In 2010, HP acquired Palm for $1.2 billion primarily to obtain its critically acclaimed WebOS mobile operating system. Under CEO Leo Apotheker, HP developed the touchpad tablet, which launched on July 1, 2011, to compete with Apple's iPad. Early reviews praised the software but criticized the hardware as sluggish and plasticky. Sales were abysmal. Best Buy reportedly sold just 25,000 units out of 270,000 received. Then came one of the most abrupt product kills in tech history. On August 18th, just 7 weeks after launch, HP announced it was discontinuing all WebOS hardware and considering selling its entire PC division. The company immediately slashed touchpad prices from $499 to $99, creating a frenzied fire sale that ironically demonstrated significant demand existed at the right price. The entire WebOS investment was written off. New CEO Meg Whitman later reversed the decision to exit the PC business, but the touchpad and WebOS were dead. The fiasco exemplified corporate strategic whiplash at its worst and demonstrated how quickly billion-dollar acquisitions can turn to dust when leadership changes direction without giving products time to find their market. 58. In December 2012, Facebook launched Poke, a direct clone of Snapchat's disappearing messages feature. Mark Zuckerberg was so convinced of its importance that he personally wrote code for the app, which was developed in just 12 days. Zuckerberg's urgency stemmed from Snapchat's explosive growth among younger users, precisely the demographic beginning to cool on Facebook. Despite Facebook's massive user base and marketing muscle, Poke was a spectacular failure, quickly dropping out of App Store rankings while Snapchat continued its meteoric rise. Just 2 years later, having failed to crush or copy Snapchat, Facebook took a different approach, trying to buy it. Zuckerberg offered $3 billion to acquire Snapchat, an offer founder Evan Spiegel famously rejected. Undeterred, Facebook then purchased WhatsApp for a staggering $19 billion in 2014, the largest acquisition of a venture-backed company in history. The WhatsApp purchase demonstrated how Facebook's failed attempt to copy Snapchat ultimately cost it billions more than an earlier acquisition might have. The episode reveals how even the most successful tech companies can miscalculate when trying to clone innovative features rather than acquire them, and how refusing to take competitive threats seriously at an early stage can lead to paying massive premiums later. 59. IBM's 2005 decision to sell its personal computer business to Chinese manufacturer Lenovo for $15 billion marked the end of an era in computing. The company that had legitimized the PC for business use with its groundbreaking 1981 IBM PC was exiting the market it had created. While critics called the move short-sighted, IBM's leadership recognized an uncomfortable truth. PC manufacturing had become a low-margin business dominated by supply chain efficiency rather than innovation. IBM's ThinkPad laptops were respected but generated minimal profits. Meanwhile, the company was being outmaneuvered by Dell's direct-to-consumer model and Asian manufacturers with lower cost structures. Under CEO Sam Palmisano, IBM pivoted toward higher-margin services and software. The decision initially appeared prescient. IBM's stock performed well for years afterward, and the company avoided the bloodbath as PC profits continued declining. However, IBM failed to capitalize on the mobile revolution that followed, missing the shift to cloud computing that would dominate enterprise IT. While the PC divestiture made sense in isolation, it reflected a larger pattern of IBM retreating from consumer technology, ultimately undermining the company's ability to anticipate how consumer trends would reshape business computing. 60. Sony's Betamax defeat in the 1970s videotape format war stands as the classic example of superior technology losing to superior business strategy. When Sony introduced Betamax in 1975, it represented a genuine breakthrough, the first practical home video recording system. Betamax offered better picture quality and more stable images than JVC's competing VHS format, which launched a year later. So why did the technically superior product lose? Sony made critical strategic errors. The company limited Beta's recording time to 1 hour versus VHS's 2 hours, critical for recording movies and sporting events. More importantly, Sony refused to license Betamax technology broadly, while JVC freely shared VHS with manufacturers like Sharp, Panasonic, and RCA. This created wider consumer choice and lower prices for VHS machines. The final blow came when Hollywood studios embraced VHS for movie rentals, creating a content advantage. By 1988, Sony effectively surrendered, beginning to sell VHS players alongside their Betamax offerings. The format war taught technology companies a painful lesson that continues to resonate today. Technical superiority alone doesn't guarantee market success, especially when competing against an ecosystem of partners with aligned interests. 61. Toshiba's HD DVD disaster demonstrates the astronomical cost of losing a format war in the digital age. In 2006, two incompatible high-definition disc formats launched: Sony's Blu-ray and Toshiba's HD DVD. On paper, HD DVD had advantages: lower manufacturing costs, backward compatibility with DVDs, and initial support from studios including Warner Bros. Toshiba invested billions in development, production capacity, and marketing, including a $150 million ad campaign featuring celebrities touting HD DVD's superiority. The decisive blow came in January 2008, when Warner Bros. Unexpectedly announced it would release exclusively on Blu-ray, giving Sony's format about 70% of Hollywood content. The reason? Sony had cleverly included Blu-ray drives in every PlayStation 3, creating an instant base of millions of players in homes worldwide. Within weeks, retailers including Walmart and Netflix abandoned HD DVD. On February 19, 2008, Toshiba announced it was ceasing all HD DVD development and manufacturing, writing off over $1 billion in losses. The format existed for barely 18 months from launch to discontinuation. Toshiba's defeat highlighted how format wars are won not just by technical merit or pricing, but by securing both content providers and a critical mass of devices in consumer homes. 62. In April 1985, after 99 years of success, the Coca-Cola Company committed one of the most infamous marketing blunders in business history, replacing its flagship product with New Coke. Blind taste tests had shown consumers preferred the sweeter taste of Pepsi, leading Coca-Cola to develop a new formula. What executives failed to understand was that Coke wasn't just a beverage, it was an American icon with deep emotional connections. The public reaction was immediate and brutal. Outraged consumers hoarded old Coke, formed protest groups, and flooded the company with angry calls, up to 8,000 daily. Coca-Cola's headquarters received letters addressed simply to Chief Dodo, Atlanta. As sales of New Coke languished, executives realized their catastrophic misjudgment. Just 79 days after New Coke's introduction, the company announced the return of the original formula as Coca-Cola Classic. When company president Donald Keogh was asked about the reversal, he offered the most honest corporate explanation ever. "We're not that dumb, and we're not that smart." The debacle is now taught in business schools worldwide as a cautionary tale about ignoring brand meaning and emotional connections. Ironically, the controversy generated so much publicity that Coca-Cola's market position actually strengthened afterward, leading to conspiracy theories that the entire fiasco was planned. 63. McDonald's 1996 Arch Deluxe campaign stands as one of fast food's most expensive failures. The burger chain spent an estimated $150–200 million developing and marketing a sandwich explicitly designed for adults. A strange strategy for a company whose entire business model depended on appealing to families with children. The product itself wasn't terrible: a quarter-pound beef patty on a bakery-style roll with a secret mustard mayo sauce. But the marketing was baffling. Commercials showed children disgusted by the sophisticated burger, while Ronald McDonald played golf and hung out in nightclubs. Imagery that confused McDonald's core customers while failing to attract the upscale diners it targeted. Despite being the most expensive product launch in McDonald's history, the Arch Deluxe flopped spectacularly. The company had projected selling 1 billion Arch Deluxes annually, but sold fewer than half that. The burger was pulled from menus after less than a year. McDonald's expensive misstep demonstrated the dangers of abandoning core brand identity to chase trendy demographics. The company's later successes came from embracing its fundamental appeal: convenience, consistency, and value, rather than trying to be something it wasn't. Sometimes the most expensive business lesson is simply remembering what business you're actually in. 64. Pepsi's Crystal disaster of 1992 perfectly captures how a clever marketing idea can blind executives to obvious consumer psychology. Riding the early 90s trend of product clarity, clear dishwashing liquid, clear beer, PepsiCo launched a colorless version of its cola with the tagline, "You've never seen a taste like this." The problem? People don't actually want to see through their cola. The clear liquid created a critical cognitive disconnect. It looked like Sprite or 7-Up but tasted, sort of, like Pepsi. This sensory contradiction made the drinking experience actively unpleasant for many consumers. Despite a $40 million launch campaign featuring Van Halen's "Right Now" and celebrities like Cindy Crawford, Crystal Pepsi sales collapsed within 6 months. Pepsi reformulated it to taste more like citrus soda, solving the cognitive disconnect but creating an identity crisis, then discontinued it entirely by late 1993. The product became such a recognizable failure that Saturday Night Live parodied it with a Crystal Gravy skit. Crystal Pepsi's spectacular flameout demonstrated a fundamental marketing principle. When visual cues and taste experiences contradict each other, consumers become uncomfortable rather than intrigued. Some product innovations are clever in theory, but disastrous in practice because they fight against deeply ingrained consumer expectations. 65. The Ford Edsel stands as the grandfather of all product failures, so infamous that Edsel became shorthand for any overhyped, underperforming product. Launched in 1957 after years of secretive development and market research, the Edsel was supposed to be Ford's entry into the mid-priced car segment. Ford spent unprecedented sums on development and marketing, even creating an hour-long CBS television special called The Edsel Show, starring Bing Crosby. But the public immediately rejected the car, particularly its distinctive vertical grille, which critics variously described as resembling an Oldsmobile sucking a lemon or a toilet seat. Beyond its polarizing aesthetics, the Edsel suffered from mechanical problems, arrived during an economic recession, and was priced higher than comparable Ford models despite sharing many components. After 3 years of dismal sales, Ford discontinued the Edsel in 1960, having lost an estimated $350 million, nearly $3.5 billion in today's dollars. The Edsel disaster taught automotive executives lasting lessons about the limitations of market research, the dangers of excessive hype, and the folly of trying to create a new brand identity without sufficient product differentiation. Sometimes a car is just a car, not the automotive revolution breathlessly promised by your marketing department. 66. Segway's patent-obsessed strategy exemplifies how focusing on legal protection rather than market adoption can doom even revolutionary technology. After inventing the self-balancing personal transporter, Dean Kamen and his team secured over 140 patents covering virtually every aspect of the device. While this created a formidable intellectual property portfolio, it also consumed enormous resources that might have been better directed toward reducing the Segway's $5,000 price tag or improving its practicality. The company became notorious for aggressively threatening legal action against anyone developing similar technology, effectively preventing a broader ecosystem of self-balancing devices that might have increased consumer acceptance. This fortress mentality extended to Segway's operations. The company maintained excessive secrecy during development and refused partnerships that might have accelerated adoption. The result? Instead of becoming the transportation revolution Kamen envisioned, Segway remained a niche product selling only a few thousand units annually. By the time the company was acquired by Chinese robotics firm Ninebot in 2015, ironically, a company Segway had previously sued for patent infringement, the technology's moment had largely passed. Segway's story demonstrates how even groundbreaking innovations can fail when companies prioritize protecting their invention over ensuring its widespread adoption and continued development. 67. Polaroid's digital disaster offers a tragic counterpoint to Kodak's failure. Another innovative giant that couldn't adapt to the technology replacing its core business. The company that pioneered instant photography had actually created working digital cameras in the 1990s, including the Polaroid PDC-2000 in 1996, relatively early in digital photography's development. Unlike Kodak, Polaroid's leadership recognized the digital threat and attempted to respond. Their fatal mistake? Believing they could maintain their razor blade business model of selling relatively inexpensive cameras while making most profits from consumables, film. Polaroid's digital strategy focused on creating digital cameras that still produced physical prints, culminating in the Pogo Instant Digital Camera that printed 2x 3-inch photos using zinc, zero-ink technology. But consumers increasingly viewed physical prints as optional, not essential, preferring to share images digitally. Meanwhile, Polaroid underinvested in improving its digital camera technology, falling behind competitors. The company filed for bankruptcy twice, in 2001 and 2008, as digital photography eliminated demand for instant film. The brand survives today under new ownership, but Polaroid's failure demonstrates how even companies that correctly identify technological threats can still fail when they cling to business models rendered obsolete by changing consumer behavior. 68. In 1998, electronics retailer Circuit City decided to revolutionize the DVD market with a format called DivX, Digital Video Express. The concept was bizarrely anti-consumer. Customers would buy DVX discs for $4.5, but could only watch them for 48 hours before having to pay additional fees to unlock them again. This required special players, proprietary hardware, and a constant phone line connection, essentially DRM before streaming, made limited viewing palatable. Circuit City invested $114 million in this scheme, convinced they'd create a recurring revenue stream and dominate the nascent DVD market. Consumers, unsurprisingly, hated the idea of purchasing movies they didn't fully own. Hardware manufacturers and movie studios were reluctant to support yet another format in the already crowded DVD launch. After 18 months of dismal sales, Circuit City killed DIVX in June 1999, offering $100 rebates to the unfortunate early adopters. The financial drain contributed to Circuit City's gradual decline, culminating in its 2008 bankruptcy. Upon reflection, the DIVX debacle stands as a perfect example of a retailer misunderstanding its own purpose. Circuit City was in the business of selling electronics, not controlling how customers used them. 69. Gateway Computer's bovine branding disaster proves that cute mascots don't save dying business models. In the late 1990s, while Dell was perfecting direct-to-consumer PC sales, Gateway doubled down on its black and white cow spot branding by opening hundreds of expensive retail stores. These stores, designed with Holstein-inspired patterns and country aesthetics, cost millions to build and staff, but generated minimal sales. Gateway founder Ted Waite, who grew up on an Iowa farm, had an emotional attachment to the cow theme that clouded his strategic judgment as the PC market commoditized. The company's country stores concept fundamentally misunderstood consumer behavior. People rarely impulse buy computers while mall shopping. While the cow spots were memorable, they positioned Gateway as folksy and rural in an industry increasingly defined by urban sophistication and technical innovation. As profit margins on PCs collapsed in the early 2000s, Gateway's expensive retail footprint became unsustainable. The company closed all its stores in 2004 and was eventually sold to Acer in 2007 for just $710 million, a fraction of its peak value. The sad irony is that the cow spots, initially chosen to represent Gateway's Midwestern values, ultimately led the company to the slaughterhouse. 70. The 3D TV mania of 2010-2017 represents one of consumer electronics' most expensive collective delusions. Major manufacturers, including Sony, Samsung, LG, and Panasonic, invested billions developing and marketing 3D televisions based on a fundamental miscalculation. They assumed the popularity of 3D movies like Avatar would naturally translate to home viewing. What they failed to consider was that nobody wanted to wear special glasses in their living room, especially uncomfortable active shutter glasses that required charging. Content availability remained severely limited, with few TV channels offering 3D programming. Even worse, many viewers reported headaches, eye strain, and nausea after watching 3D content. Despite massive marketing campaigns and premium pricing, 3D TV adoption peaked at less than 10% of households. By 2017, virtually all manufacturers had abandoned the technology, quietly removing 3D capabilities from their new models. The 3D TV fiasco provides a sobering lesson in technology adoption. Features that consumers tolerate occasionally in public settings, like movie theaters, may be completely unacceptable as daily requirements in private ones. When an industry collectively convinces itself that consumer behavior will dramatically change to accommodate a new technology rather than the other way around, disaster invariably follows. 71. Quibi's mobile-only strategy serves as a masterclass in how to ignore obvious consumer preferences while burning through nearly $2 billion, founded by entertainment mogul Jeffrey Katzenberg and led by former HP CEO Meg Whitman. Quibi, short for Quick Bites, launched in April 2020 with a revolutionary idea. Premium short-form video viewable only on smartphones, no TV apps, no web player, not even screen mirroring initially. This decision was based on the conviction that modern consumers wanted to watch HBO-quality content in 10-minute increments while waiting in line for coffee. The fundamental flaw? People who pay for premium content generally want to watch it on the biggest screen available. Launching during a pandemic, when everyone was stuck at home staring at their TVs, only highlighted this miscalculation. After spending $175 billion on development and signing A-list talent, Quibi shut down just 6 months after launch. The service peaked at a mere 10,000 subscribers, a fraction of the 7 million first-year subscribers projected. When examined rationally, the strategy simply made no sense. Why limit how customers can consume content they're paying for? The Quibi debacle demonstrated that even brilliant executives can become blind to common sense when enamored with their own disruptive vision. 72. Google Plus stands as perhaps the most expensive attempt to copy a competitor in tech history. In 2011, alarmed by Facebook's growing dominance in social media, Google launched Google Plus with the full weight of its engineering talent and marketing muscle. The company went all in, integrating Google Plus with nearly every Google product and requiring users to create accounts to use services like YouTube. This forced adoption strategy created millions of ghost accounts but little genuine engagement. Despite technically sophisticated features like circles for managing privacy, Google Plus never solved the fundamental empty room problem. Users found no compelling reason to switch from Facebook, where their friends and family already existed. After 7 years and an estimated investment exceeding $1 billion, Google announced the consumer version would shut down following a data breach that exposed 500,000 users' information. The true cost wasn't just financial. Google's obsession with catching Facebook distracted the company during social media's formative years and damaged its reputation through invasive integration tactics. Perhaps most tellingly, when Google Plus finally closed in 2019, the internet barely noticed. The episode offers a clear lesson. Even with unlimited resources, you can't force users into a social network they don't want to join. 73. In May 2013, Microsoft made a console launch decision so misguided it handed Sony's PlayStation 4 a market advantage it would maintain for an entire generation. When unveiling the Xbox One, Microsoft announced that every console would include the Kinect motion sensor, a sophisticated but unwanted peripheral that added $100 to the price tag, pushing it to $499. The PlayStation 4, meanwhile, launched at $399 without forcing a camera accessory on consumers. Microsoft's logic was that Kinect would enable revolutionary voice and motion gaming experiences, making it an essential component rather than an optional accessory. The market emphatically disagreed. Gamers resented paying extra for a feature many viewed as gimmicky, while privacy concerns about an always-on camera and microphone further dampened enthusiasm. The price differential devastated Xbox sales from the start, with PS4 outselling Xbox One nearly 2-to-1 in the crucial launch period. After 6 months of lagging sales, Microsoft finally reversed course, offering a Kinect-free bundle at $399, but the damage was done. By forcing an unwanted accessory on customers, Microsoft committed the cardinal sin of hardware marketing, ignoring what consumers actually wanted in favor of what executives thought they should want. 74. Yahoo's 2000 partnership with Google represents perhaps the most costly outsourcing decision in business history. In the early days of the internet, Yahoo was the dominant web portal. But rather than viewing search as a strategic priority, they considered it a commodity feature. Looking to offload the expensive distraction of developing search technology, Yahoo signed a 4-year deal to use Google's search engine on their site. This seemingly minor decision handed Google exactly what it needed most: massive exposure and query data. With every search performed on Yahoo, Google refined its algorithms and gained new users. By the time Yahoo realized search was actually the gateway to the internet's future advertising riches, Google had built an insurmountable lead. When Yahoo finally attempted to reclaim control by purchasing Google in 2002, they balked at the $5 billion asking price, a bargain considering Google's current $1.7 trillion valuation. Yahoo's mistake wasn't just failing to see search's importance, it was actively strengthening their most dangerous competitor. The painful irony is that Yahoo could have been Google, as they possess the traffic, engineering talent, and resources to dominate search. Instead, they outsourced their future and watched as Google built an empire on their foundation. 75. AOL's commitment to dial-up internet in the broadband era represents one of technology's most spectacular cases of business model denial. By 2005, it was clear that broadband was rapidly replacing dial-up access, yet AOL continued focusing on its legacy service, the famous "You've Got Mail" experience that had once defined the online world for millions. Why? Because dial-up subscribers generated enormous profits, paying $25 monthly for service that cost very little to provide. Rather than transitioning aggressively to broadband partnerships or developing compelling content that would remain relevant in a high-speed internet world, AOL's strategy amounted to milking its declining subscriber base for as long as possible. The results were predictable. AOL's subscriber count collapsed from 26.7 million in 2002 to just 4.6 million by 2010, as consumers switched to faster cable and DSL connections. The company that had once been synonymous with the internet became a cautionary tale in tech business schools. Though AOL eventually attempted to reinvent itself as a digital media company, the delayed transition cost it years of potential development and billions in market value. AOL's stubborn attachment to its dying cash cow illustrates a painful truth of business evolution. Sometimes sacrificing your most profitable product is necessary for long-term survival. 76. Netflix's 2011 Quickster debacle provides a textbook example of how not to implement a business model transition. In July 2011, CEO Reed Hastings announced Netflix would split its DVD by mail and streaming services, requiring customers to maintain separate accounts and billing relationships. The DVD service would be rebranded as Quickster, a name that sounded like a bad energy drink. Customers were furious, viewing the change as an inconvenient price increase, masquerading as a service improvement. The backlash was immediate and severe. Netflix lost 800,000 subscribers in a single quarter, and its stock plummeted from $300 to $63, a 77% drop in market value. Just 3 weeks after the announcement, Hastings killed Quickster before it even launched. What made the fiasco particularly remarkable was that Netflix had correctly identified the strategic imperative to focus on streaming, but completely bungled the execution by prioritizing internal organizational logic over customer experience. The company recovered only after Hastings publicly apologized, admitting, "I slid into arrogance based upon past success." The Quickster affair offers a sobering lesson in change management. Even the right strategic vision can fail catastrophically when implemented without considering how it impacts the people who actually pay for your service. 77. Borders Books' digital blindness stands as one of retail's most preventable bankruptcies. While Amazon was building the future of bookselling, Borders made 2 decisions that sealed its fate: outsourcing its online sales to Amazon in 2001 and dismissing ebooks as a passing fad. The Amazon partnership was particularly self-destructive. Borders essentially handed its online customers directly to its most dangerous competitor. As for ebooks, former CEO Greg Josefowicz said in 2008, "I don't see Amazon's Kindle taking over anytime soon," just as digital book sales were beginning their exponential growth. While Barnes & Noble developed its Nook e-reader and built digital capabilities, Borders doubled down on expanding physical stores and selling CDs and DVDs, categories already being disrupted by digital downloads. By the time Borders belatedly launched its own ebook store in 2010, the market was already dominated by Amazon's Kindle, Apple's iBooks, and B&N's Nook. Without a digital transition strategy, Borders filed for bankruptcy in 2011 and liquidated all stores, ending the 40-year history of what was once America's second-largest bookstore chain. The company's downfall illustrates how even obvious technological trends can be fatally ignored when they threaten a business's traditional identity. 78. Compaq's abandonment of the iPac smartphone line in 2002 stands as one of tech's most short-sighted product cancellations. Years before the iPhone revolutionized mobile computing, Compaq had created the iPac Pocket PC phone, a Windows-powered device combining PDA functions with cellular connectivity. The product showed remarkable foresight, offering web browsing, email, and third-party applications in a pocket-sized format. Yet after HP acquired Compaq in 2002, the combined company gradually neglected the iPac smartphone line, viewing mobile devices as a niche market compared to their core PC business. By 2007, when Apple unveiled the iPhone, HP had effectively abandoned the smartphone category it had helped pioneer. The company belatedly attempted to re-enter the market by acquiring Palm in 2010, only to kill Palm's WebOS platform just a year later. Had HP maintained Compaq's early momentum in smartphones, it might have established a dominant position in what would become a trillion-dollar market. Instead, the company watched from the sidelines as Apple and Google's Android platform revolutionized computing. The iPac's premature demise illustrates how large technology companies often fail to recognize emerging product categories that don't immediately fit their established business models, even when they themselves are developing the innovations that could define those categories. 79. Time Warner Cable's 2009 experiment with broadband caps exemplifies how companies can alienate customers by trying to monetize previously unlimited services. Facing growing network demands from streaming video, TWC announced plans to charge customers based on data usage, with plans starting at $15 monthly for a paltry 1 GB allowance, enough for about one HD movie, and escalating to $75 for 100 GB. The company presented this as a consumer-friendly pricing model that would allow light users to pay less. Customers saw through this immediately, recognizing it as a transparent attempt to either extract more revenue or discouraged streaming services that competed with TWC's cable TV offerings. The public backlash was immediate and fierce, drawing attention from consumer, advocates, and legislators. New York Congressman Eric Massa called the plan nothing more than a giant consumer ripoff and threatened legislation. Facing mounting pressure, TWC abandoned the plan just 4 weeks after announcing it. The company would try again with less draconian caps in subsequent years, but never fully implemented the usage-based billing model it desired. The debacle demonstrated how attempts to artificially constrain a service previously offered as unlimited can trigger massive customer resistance, especially when the constraints seem designed primarily to protect legacy business models rather than address genuine resource limitations. 80. Motorola's mismanagement of the Razr brand offers a cautionary tale in how to squander a breakthrough product advantage. The original Razr V3, launched in 2004, was a genuine phenomenon, a stunningly thin flip phone that became a status symbol and sold over 130 million units. Rather than using this success to fund development of truly innovative successors, Motorola chose to milk the Razr name by releasing dozens of slightly modified variants. By 2007, consumers could choose from the Razr V3C, V3i, V3T, V3M, V3X, V3X, and many more, each with minimal improvements and increasingly confusing distinctions. This focus on incremental variations came at the expense of developing truly next-generation devices. When Apple unveiled the iPhone in January 2007, Motorola was caught completely flat-footed, still releasing slightly tweaked flip phones while the smartphone revolution began. The company's market share collapsed from 21.4% in 2006 to just 8.4% by 2009. Motorola's mobile division, once valued at billions, was eventually sold to Google in 2012 for $12.5 billion, then resold to Lenovo for just $291 billion 2 years later. The Razr saga demonstrates how easy it is for companies to become victims of their own success, focusing on exploiting a hit product rather than preparing for the technological shifts that will inevitably render it obsolete. 81. Nokia's exclusive commitment to Windows Phone in 2011 stands as perhaps the most disastrous platform bet in mobile history. At the time, Nokia was still the world's largest phone manufacturer, but was losing ground to Apple's iPhone and Google's Android. New CEO Stephen Elop, a former Microsoft executive, made a fateful decision. Nokia would abandon its own Symbian and MeeGo operating systems to exclusively adopt Microsoft's Windows Phone platform. In a leaked internal memo dubbed the Burning Platform email, Elop compared Nokia to a man standing on a burning oil platform who must jump into the freezing ocean to survive. The company did jump right into an iceberg. Windows Phone never gained significant market traction, reaching a peak market share of just 3.6%, despite Nokia's hardware expertise and global distribution. Meanwhile, Nokia abandoned MeeGo just as it was releasing the N9, a phone so well received that reviewers wondered if it could have been a viable third ecosystem. By 2013, Nokia's smartphone market share had collapsed from 34% to 3%, and its handset division was sold to Microsoft for $7.2 billion. Microsoft would later write off the entire acquisition as worthless. Nokia's Windows Phone alliance illustrates the existential danger of betting your company's future on a partner's platform that consumers simply don't want. 82. BlackBerry's Playbook tablet launch in 2011 represents one of the most bewildering product releases in tech history. Rushing to compete with Apple's iPad, BlackBerry, then called Research in Motion, unveiled a tablet missing the company's signature feature, email. Incredibly, the Playbook launched without native email, calendar, or contacts apps, requiring users to connect their BlackBerry phones via Bluetooth to access these basic functions. For a company whose entire identity was built around secure, reliable mobile email, this omission was inexplicable. Reviews were brutal, with Walt Mossberg of the Wall Street Journal writing, "I've never tested a computer that is so good at many things and so inept at others." Despite investing over $500 million in development, BlackBerry sold just 500,000 units in the first quarter, far below projections. and was forced to take a $485 million inventory write-down later that year as unsold devices piled up in warehouses. The company finally added native email 7 months after launch, but by then, the market had moved on. The Playbook disaster accelerated BlackBerry's decline from smartphone pioneer to industry footnote. Beyond the financial impact, the episode revealed a company so organizationally dysfunctional and strategically confused that it couldn't leverage its core competency in a new product category. 83. Palm's WebOS represents one of mobile computing's most tragic what-if stories. Brilliant technology hamstrung by financial constraints and market timing. Founded by Jeff Hawkins in 1992, Palm had pioneered the PDA market with the Palm Pilot before struggling during the early smartphone transition. The company's 2009 Hail Mary was WebOS, a revolutionary mobile operating system built around web technologies with true multitasking and elegant gesture controls. The Palm Pre, launched in June 2009, received glowing reviews. The New York Times called it a credible challenger to the iPhone, and the WebOS interface was widely praised as superior to both iOS and Android at the time. What went wrong? Palm lacked the financial resources for a protracted platform war against Apple and Google. The company's exclusive launch partnership with Sprint, then the third-place U.S. carrier, limited its market reach. Most critically, Palm couldn't attract enough developers to build a competitive app ecosystem. By 2010, Palm was running out of cash and sold to HP for $1.2 billion. HP initially promised major investment in WebOS before abruptly abandoning the platform just 16 months later. The story of WebOS demonstrates how even technological excellence can't overcome market timing, financial constraints, and strategic mismanagement. 84. MySpace's self-destructive redesign obsession in the late 2000s offers a perfect case study in how to alienate users while your competitors are stealing them. At its peak in 2008, MySpace was the world's most popular social network with over 75 million monthly visitors. But as Facebook gained momentum, MySpace responded with a series of increasingly chaotic redesigns that confused and frustrated its user base. While Facebook maintained a clean, consistent interface that users could rely on, MySpace morphed constantly, changing layouts, features, and focus in a desperate attempt to remain relevant. The site became infamous for its cluttered profiles, auto-playing music, and garish customization options that made many pages nearly unreadable. Each redesign seemed to accelerate user departures rather than stemming the tide. News Corporation, which had purchased MySpace for $580 million in 2005, eventually sold it for just $35 million in 2011, a 94% loss. By then, MySpace had been thoroughly eclipsed by Facebook. The once dominant platform's collapse demonstrates how easily user experience inconsistency can destroy network effects in social media. While Facebook understood that social networks are infrastructure that users rely on, MySpace treated its platform like a product that needed constant reinvention, ultimately redesigning itself into irrelevance. 85. Groupon's 2011 IPO represents one of the most dramatic valuation collapses in tech history. Founded in 2008, the Daily Deals site grew explosively by offering steep discounts on local services and splitting the revenue with merchants. Investors went wild for Groupon's rapid growth, valuing the company at $16 billion when it filed to go public in 2011. Behind the growth story lurked serious problems. The business model showed few signs of sustainable profitability. Merchant satisfaction was declining as many lost money on Groupon promotions, and the company was using questionable accounting metrics to make its finances look healthier than they were. The SEC forced Groupon to revise its filing documents, but even this red flag didn't deter investors from valuing the company at $12.7 billion at IPO. Reality set in quickly. Many merchants found Groupon deals attracted only discount hunters who never returned at full price. Customer acquisition costs rose as Daily Deals novelty wore off. By March 2020, Groupon's market cap had plunged to just $400 million, a 97% decline from its IPO valuation. The company's trajectory from fastest-growing company ever to cautionary tale illustrates the dangers of confusing rapid growth with sustainable business fundamentals, especially when that growth depends on a model that creates questionable value for all participants. 86. Zynga's catastrophic failure to transition from Facebook games to mobile stands as one of gaming's most predictable yet unavoidable business collapses. Founded in 2007, Zynga built a gaming empire on Facebook with titles like Farmville and Cityville that dominated users' news feeds with viral game requests. The company's IPO in December 2011 valued it at $7 billion based on this Facebook-dependent business. Just months later, two seismic shifts occurred. Facebook clamped down on the viral channels Zynga relied on for free user acquisition, and gaming activity rapidly migrated from desktop to mobile devices. Zynga had built its entire technical and business infrastructure around Facebook's platform rather than developing mobile expertise. When the company finally pivoted to mobile, it relied on expensive acquisitions rather than internal innovation, most notably paying $180 million for OMG Pop, maker of the briefly popular Draw Something app. The acquisition proved disastrous when Draw Something's usage collapsed just weeks later. By 2013, Zynga had laid off over 500 employees and closed multiple studios as revenues plummeted. The company's stock fell from its $10 IPO price to just $2.20 by 2013. Zynga's spectacular rise and fall demonstrates the existential danger of building your business on a platform you don't control, especially when consumer behavior is rapidly shifting to devices you've neglected. 87. Pandora's failure to expand internationally represents one of the most perplexing self-inflicted limitations in digital media history. Founded in 2000, Pandora pioneered music streaming with its personalized radio service based on the Music Genome Project. The company focused exclusively on the US market due to the complexities of music licensing across different countries. This made sense initially, but as streaming became mainstream, Pandora's domestic-only strategy became increasingly problematic. While Spotify launched in multiple countries beginning in 2008 and eventually expanded to over 180 markets, Pandora remained stubbornly US-centric, adding only Australia and New Zealand in 2012. This geographic limitation capped Pandora's potential user base at less than 5% of the global population. By the time Pandora finally considered serious international expansion around 2017, Spotify had already established dominance in key markets worldwide. Pandora's domestic focus also made it vulnerable to competition from deep-pocketed tech giants like Apple, Amazon, and Google, all of which launched competing services with global ambitions. After years of declining listenership and financial struggles, Pandora was acquired by SiriusXM in 2019 for $3.5 billion, far less than Spotify's $30+ billion valuation. The costly lesson? In digital services with global appeal, geographic self-limitation eventually becomes a competitive disadvantage that's nearly impossible to overcome. 88. Twitter's decision to kill Vine in 2016 stands as one of tech's most short-sighted product, shutdowns. The 6-second video platform had attracted 200 million monthly active users and launched the careers of numerous social media stars. Vine was becoming a cultural phenomenon, particularly among younger users, precisely the demographic most valuable to advertisers. So why did Twitter shut it down? The company was under pressure to cut costs amid stagnating growth, and Vine wasn't generating significant revenue despite its popularity. More critically, Twitter failed to recognize the explosive growth potential of short-form video, viewing Vine as a secondary product rather than a potential future core of its business. The consequences became painfully clear when TikTok emerged to dominate precisely the short-form video space Vine had pioneered. By 2022, TikTok had surpassed 1 billion monthly active users and was valued at over $50 billion. Former Twitter employees have confirmed that many of the features that made TikTok successful were planned for Vine before its cancellation. The company essentially handed a massive market opportunity to a future competitor by failing to properly value and invest in the cultural momentum its own product had created. Twitter's Vine shutdown represents a spectacular failure of strategic foresight, the corporate equivalent of selling Manhattan for $24 worth of trinkets. 89. Snap's spectacles. Fiasco demonstrates how easily tech companies can mistake internal enthusiasm for actual market demand. In 2016, Snap Inc., formerly Snapchat, unveiled its first hardware product, sunglasses with an integrated camera for capturing 10-second videos to share on Snapchat. The company created artificial scarcity and hype by selling spectacles exclusively through quirky yellow vending machines that appeared without warning in various locations. This marketing gimmick generated substantial media coverage and initial excitement. The reality? Actual consumer interest was minimal. Most people simply didn't want to wear conspicuous camera glasses, regardless of their connection to a popular app. By late 2017, Snap disclosed it had sold only 150,000 pairs of the original spectacles and taken a $39.9 million write-down on unsold inventory. Undeterred by this market rejection, the company inexplicably released second and third generations of the product with minimal changes to address fundamental consumer objections. These newer versions fared even worse. Despite continuing to develop AR glasses technology, Snap has never achieved meaningful adoption for spectacles. The persistent pursuit of a product concept that consumers repeatedly rejected suggests a dangerous echo chamber within Snap's leadership, a reminder that even the most innovative tech companies can become blind to market reality when sufficiently enamored with their own ideas. 90. Facebook's Portal devices represent one of tech's most tone-deaf product launches. In October 2018, just months after the Cambridge Analytica scandal exposed Facebook's cavalier attitude toward user privacy, the company unveiled Portal, video calling devices with cameras and microphones designed to sit in users' homes. The timing couldn't have been worse. Facebook was facing unprecedented public scrutiny over data practices, and here they were asking consumers to install Facebook-connected cameras in their bedrooms and living rooms. Consumer response was predictably skeptical. Reviews consistently praised the hardware while questioning whether anyone should trust Facebook with even more intimate access to their homes. Sales were reportedly dismal, with the company refusing to release specific figures. Never a good sign. Despite adding features and releasing new models, Portal devices failed to gain meaningful market share against competitors like Amazon Echo Show and Google Nest Hub. After 4 years of weak sales, Facebook, by then renamed Meta, announced in 2022 it would phase out Portal as a consumer product, repositioning the technology for business use. The Portal misadventure demonstrates a fundamental business principle: timing and trust matter as much as technology. Even excellent products can't overcome launching from a company facing a profound crisis of consumer confidence. 91. Google's Stadia gaming service exemplifies how even technical excellence can't overcome fundamental strategic misjudgments. Launched in 2019, Stadia promised to revolutionize gaming by streaming high-quality titles from the cloud, eliminating the need for expensive consoles or PCs. The technology was impressive. Games ran smoothly with minimal latency, showcasing Google's networking expertise. The business model, however, made little sense. Rather than offering a Netflix-style subscription with included games, as Microsoft did with Game Pass, Google required users to purchase individual titles at full price, then pay a monthly subscription for premium features. This approach combined the downsides of both ownership and subscription models, while adding the unique disadvantage of games that would become inaccessible if the service shut down, which is exactly what happened. After struggling to attract developers and users, Google announced in September 2022 that it would shutter Stadia just 3 years after launch, refunding all hardware and software purchases. The estimated cost of this failure exceeds $500 million. While cloud gaming itself continues to grow through services like Xbox Cloud Gaming and NVIDIA GeForce Now, Stadia's demise demonstrates that even technically superior products can fail when their business model fundamentally misaligns with consumer expectations and creates unnecessary friction. 92. Amazon's Fire Phone stands as one of tech's most humbling product failures, proof that even the world's most successful e-commerce company can completely misread consumer desires. Launched in July 2014 as a premium device priced identically to the iPhone at $199 with contract, the Fire Phone featured dynamic perspective, which used 4 front-facing cameras to create a quasi-3D interface that shifted based on how users held the phone. Its other marquee feature, Firefly, could recognize products for easy purchasing on Amazon. The problem? Nobody wanted either feature enough to abandon the established iOS and Android ecosystems. What consumers saw as gimmicks, Amazon had spent years and hundreds of millions of dollars developing. Just 49 days after launch, Amazon slashed the price to 99 cents with contract, a desperate move that failed to ignite sales. By October 2014, the company took a $170 million write-down on unsold inventory. Production ceased the following year. Beyond the financial hit, the Fire Phone's failure revealed Amazon's fundamental misunderstanding of smartphone purchasing decisions. Users choose phones based on app ecosystems, camera quality, and design, not shopping features. Even Amazon's legendary customer obsession couldn't save a product built around the company's needs rather than customers' desires. 93. Microsoft's Mixer shutdown exemplifies how even unlimited resources can't guarantee success in the competitive streaming market. In 2016, Microsoft acquired the streaming platform Beam, later renamed Mixer, to compete with Amazon's Twitch in the growing game streaming space. After years of limited growth, Microsoft made a bold move in August 2019, signing Twitch superstar Tyler "Ninja" Blevins to an exclusive contract reportedly worth $20–30 million. The company followed with similar deals for other top streamers, spending an estimated $50 million on talent alone. Despite these massive investments, Mixer never gained significant market traction. The platform struggled with technical issues and failed to create the community culture that made Twitch successful. Just 11 months after signing Ninja, Microsoft announced it was shutting down Mixer entirely, partnering with Facebook Gaming instead. The sudden closure left content creators scrambling, while the high-profile exclusive streamers were released from their contracts after receiving full payment for deals they'd barely begun. Beyond the wasted talent contracts, Microsoft had invested hundreds of millions in Mixer's technology and infrastructure. The spectacular failure demonstrated that in platform businesses dependent on network effects, even tech giants can't simply buy their way to relevance without creating genuine user value and community engagement that competitors lack. 94. Google Glass Enterprise's discontinuation in 2023 marked the final chapter in one of tech's most emblematic product failures. After Google Glass flopped as a consumer product in 2014 due to privacy concerns and its glass hole image problem, the company pivoted to focus exclusively on enterprise applications. This seemed promising. In factory, warehouse, and medical settings, the hands-free access to information made practical sense without the social awkwardness that doomed the consumer version. Google launched Glass Enterprise Edition in 2017 and a second generation in 2019, attracting customers including Boeing, DHL, and Volkswagen. The company emphasized that, unlike the consumer failure, Glass had found its proper niche in business environments. Yet in March 2023, Google announced it was discontinuing Glass Enterprise entirely, ending a decade-long, multi-billion-dollar effort to make AR glasses viable. What happened? Despite some adoption, Glass never achieved the scale needed to justify continued investment, particularly as competitors like Microsoft HoloLens and Meta Quest offered more advanced capabilities. The Glass saga perfectly encapsulates Google's product development pattern. Technically brilliant innovations undermined by poor market understanding, inadequate long-term commitment, and a culture that moves on to new projects before fully realizing existing ones. Even when Google found the right application for Glass, the company couldn't sustain the focus needed to make it successful. 95. Facebook's Libra cryptocurrency represents one of the most ambitious corporate projects to collapse under regulatory pressure. Announced in June 2019, Libra, later renamed Diem, was intended to be a stable digital currency backed by a basket of international currencies and government securities. Facebook assembled an impressive coalition of partners, including MasterCard, Visa, PayPal, and Uber, creating the Libra Association to govern the currency. The vision was genuinely transformative, a global payment system reaching billions of users, including the 1.7 billion people worldwide without bank accounts. The announcement immediately triggered alarm bells among regulators and lawmakers worldwide. Central banks feared a Facebook-controlled currency could undermine monetary sovereignty, while privacy advocates worried about combining financial data with Facebook's existing social information. Within months, major partners including PayPal, Visa, and MasterCard abandoned the project. Despite Facebook's attempts to address regulatory concerns by scaling back ambitions and rebranding as Diem, the opposition proved insurmountable. In January 2022, the Diem Association sold its assets to Silvergate Bank for just $182 million, a tiny fraction of the investment made. The Libra-Diem saga demonstrated that even the world's largest technology companies can't simply disrupt regulated industries without government cooperation, especially when their past behavior has created deep trust deficits with both regulators and the public. 96. Intel's failure to prioritize mobile processors in the 2000s represents one of tech's most costly strategic misjudgments. As smartphones began their explosive growth, Intel remained focused on its highly profitable PC and server chips, viewing mobile as a low-margin distraction. The company's x86 architecture, dominant in computers, was too power-hungry for battery-operated devices. Meanwhile, ARM Holdings was licensing processor designs specifically optimized for mobile applications. When Apple launched the iPhone in 2007 using an ARM-based processor, Intel still didn't recognize the existential threat. By the time Intel finally committed significant resources to mobile with its Atom processor line in 2012, ARM licensees like Qualcomm, Apple, and Samsung had established an insurmountable lead. Even offering chips below cost couldn't convince smartphone makers to switch architectures. By 2016, Intel essentially abandoned the smartphone processor market entirely, canceling future Atom development and taking a substantial write-down. The missed opportunity was staggering. Analysts estimate the mobile processor market represented a $100+ billion opportunity that Intel simply ceded to competitors. The company's mobile blindness demonstrates how dominant market positions can create dangerous complacency. Intel was so focused on protecting its existing business that it failed to see an adjacent market that would eventually eclipse it in importance. 97. Yahoo's premature sale of half its Alibaba stake in 2012 stands as one of the worst timing decisions in corporate finance. In May 2012, Yahoo sold approximately half of its 40% stake in Chinese e-commerce giant Alibaba back to the company for $7.1 billion. This seemed like a substantial win at the time. Yahoo had acquired the stake for just $1 billion in 2005. What Yahoo failed to anticipate was how dramatically Alibaba would grow over the next few years. When Alibaba went public in September 2014, it was valued at $231 billion, making Yahoo's remaining shares worth about $37 billion, more than Yahoo's entire market capitalization. Had Yahoo retained its full stake, it would have been worth approximately $74 billion. The sale became such an obvious blunder that it overshadowed Yahoo's core business in investor discussions. The company that had once defined the internet was, by 2015, valued by Wall Street primarily as a holding company for Alibaba shares, rather than for its own operations. Yahoo ultimately sold its core business to Verizon in 2017 for just $448 billion, a fraction of what it had surrendered by selling Alibaba shares prematurely. The episode demonstrates how pressure for short-term returns can lead companies to make catastrophic long-term value decisions. Yahoo generated a quick win for shareholders in 2012, but sacrificed exponentially greater value that would have materialized just 2 years later. 98. Xerox's rejection of the personal computer in 1973 stands as perhaps the most legendary missed opportunity in tech history. At Xerox's Palo Alto Research Center, PARC, brilliant engineers had created the Alto, the world's first true personal computer with a graphical user interface, mouse, and networking capabilities. When PARC researchers demonstrated this revolutionary machine to Xerox executives, they were met with indifference. The company was making billions selling copiers and saw no reason to diversify into an unproven market with lower margins. This myopic view prevented Xerox from commercializing numerous world-changing innovations developed at PARC, including the graphical user interface, Ethernet networking, and the laser printer. The consequences became apparent when Steve Jobs visited PARC in 1979. Recognizing the significance of what he saw, Jobs immediately redirected Apple's efforts to incorporate these ideas into what would eventually become the Macintosh. Xerox did attempt to enter the personal computer market with the Star Workstation in 1981, but priced it at $1,600, $50,000 today, targeting institutions rather than individual users. The company's fundamental misunderstanding of the personal computer's potential represented a multi-trillion-dollar missed opportunity. Xerox had invented the future but couldn't see beyond its copier business to capitalize on it. 99. Kodak's failure to monetize its digital photography patents represents one of intellectual property's greatest ironies. The company that invented the digital camera in 1975 accumulated over 1,000 digital imaging patents that would become fundamental to virtually every digital camera, smartphone, and image-sharing service. Throughout the 1990s and 2000s, as Kodak's film business collapsed, the company attempted to generate revenue by licensing these patents, extracting settlements from companies including LG, Samsung, and Sony. While these efforts generated approximately $3 billion in licensing revenue, they represented a fraction of the patent's potential value had Kodak developed a coherent IP strategy earlier. By the time Kodak filed for bankruptcy in 2012, its patent portfolio had become its most valuable remaining asset. Yet even here, timing worked against the company. Kodak sold its digital imaging patent portfolio in bankruptcy for just $525 million to a consortium including Apple, Google, and Facebook, companies whose businesses depended on the very technologies Kodak had pioneered. The patent saga completes Kodak's tragic arc. Having invented digital photography, failed to embrace it as a business, and finally surrendered its intellectual property for pennies on the dollar to the companies that had built trillion-dollar businesses on its innovations. Upon reflection, Kodak's inability to capitalize on its own brilliance stands as perhaps the most complete form of technological self-destruction in business history. 100. Blackstone's 2007 acquisition of Hilton Hotels perfectly captures the perils of peak market timing in private equity. At the height of the pre-financial crisis real estate bubble, Blackstone paid $26 billion for Hilton, the largest hotel acquisition in history. The deal included $20.5 billion in debt financing, secured against hotel properties valued at bubble-era prices. Just months later, the 2008 financial crisis devastated both travel demand and real estate values, leaving Blackstone underwater on its investment. By 2009, the firm had written down its $5.5 billion equity investment in Hilton by 70%, and the debt needed restructuring as hotels lost value and revenue. Most private equity firms would have walked away from such a disaster, but Blackstone made an extraordinary decision. Rather than surrendering Hilton to creditors, they negotiated debt restructurings and invested additional capital during the downturn to renovate properties and expand Hilton's brand portfolio. This contrarian move paid off spectacularly. As the economy recovered, Hilton's value rebounded. Blackstone took Hilton public in 2013 and fully exited the investment by 2018, ultimately turning the near catastrophe into a $14 billion profit, one of the most profitable private equity deals ever. The Hilton saga demonstrates that in financial disasters, initial timing mistakes can sometimes be overcome through crisis management skill and the courage to double down when others are fleeing. And finally, for our last one, 101. SoftBank's WeWork investment stands as perhaps the most spectacular example of irrational exuberance in venture capital history. Between 2017 and 2019, Masayoshi Son's SoftBank Vision Fund poured $18.5 billion into the office-sharing company, valuing it at an astounding $47 billion despite massive losses and questionable governance. Son reportedly made the initial investment decision after a 12-minute meeting with WeWork founder Adam Neumann, later explaining he invested based on feeling rather than traditional metrics. This feeling led SoftBank to value WeWork higher than established real estate companies with actual profits and far more property. When WeWork filed for its IPO in August 2019, public market investors were shocked by the company's financial reality. $1.9 billion in losses on $1.8 billion in revenue, bizarre related party transactions benefiting Neumann personally, and no clear path to profitability. The IPO collapsed spectacularly as WeWork's valuation plummeted to $8 billion, an unprecedented $39 billion evaporation of perceived value. SoftBank was forced to bail out the company with another $9.5 billion to prevent bankruptcy, while ousting Neumann with a $1.7 billion exit package. The debacle fundamentally changed venture capital, ending an era where growth at all costs trumped basic business fundamentals. Sometimes the most valuable investment lessons come from watching someone else light billions of dollars on fire while claiming to see the future. So that wraps up our journey through the dumbest financial decisions ever made. From the 1600s tulip mania to SoftBank's $18.5 billion WeWork disaster, history proves that even the smartest minds can make catastrophic money mistakes. But what do you think? Are these financial blunders simply products of their time, or evidence that human psychology never truly changes when it comes to greed and FOMO? Did Kodak's rejection of their own digital camera technology surprise you the most? Did we miss any financial failures that deserve to be on this list? Share your nominations in the comments. The most shocking ones get pinned. If you're fascinated by these money mishaps, prove it. Hit like, subscribe, and ring the bell to catch our upcoming breakdown of how billionaires actually built their wealth. Thanks for joining me on this journey through history's worst financial blunders. From the 17th century tulip mania to the FTX crypto collapse, these disasters remind us that human psychology rarely changes. We repeatedly fall for the same traps of greed, FOMO, and willful blindness. The market might have evolved from tulip bulbs to digital tokens, but the costly lessons remain eerily similar. But now it's your turn. What do you think? Are these financial disasters proof that markets eventually correct themselves, or evidence that we'll never learn? Maybe Bernie Madoff's $65 billion Ponzi scheme or Elizabeth Holmes's Theranos fraud changed how you view investment opportunities. Did we miss any spectacular financial failures that deserve a spot on this list? Share your personal favorite financial disaster in the comments. The most insightful responses get pinned. If you enjoyed this dive into financial folly, don't miss what's coming next. Hit subscribe and ring that bell for our upcoming exploration of the world's greatest comeback stories.